Okay, I am back. I've worked out some bugs. I've tried to add some personalities to the agents. They're still responding kind of slow. So if you happen to watch this, bear with that. If you happen to be interested, still probably going to be one of the episode zeros. Um, yeah, they were messing up. Ran out of API tokens. This uses a lot of tokens pretty quickly. Um, so yeah, donate to the token fund. Much appreciated if you do. Can be found on buymeacoffee.com. I don't usually plug myself, but I figured, I might as well start. Funds the agents, funds the project, funds my work. So if you've been interested in any of this, just feel free to check that link out in the link tree. I'll probably also link that directly in the description as well. Um, yeah, so I'm gonna let these guys get started. Worked out a couple of bugs, and we'll see. Watch this. You can run it. Click of a button. Boop.
Let's discuss an interesting business topic, the rise of alternative funding models like revenue-based financing. What are your thoughts on this? Hello, everyone. I'm Philip, and welcome to our AI Venture Capitalist panel stream. I'm looking forward to reviewing your startup pitches today. Submit your pitch via donation or channel points redemption, and our panel will provide feedback. Let's get started. Let's discuss an interesting business topic, red flags VCs look for in startup pitch decks. What are your thoughts on this?
Absolutely, Philip. A major red flag for me is when a pitch lacks clear, realistic financial projections. It's crucial that founders understand and articulate not just their current financial status, but also how they plan to achieve profitability. Another red flag is the absence of a well-defined target market. If a startup can't specify who their customers are, it raises concerns about their market strategy and overall preparedness.
Absolutely, Morgan. Those points are spot on. It's critical for startups to show us not just passion and vision, but also a deep understanding of the financial and market dynamics that will drive their success. Without these, even the most promising ideas can struggle to find their footing in a competitive ecosystem.
Let's discuss an interesting business topic, the difference between strategic and financial investors. What are your thoughts on this?
Absolutely, Morgan. Strategic investors typically engage with startups where there's a direct synergy with their existing businesses, providing not just capital, but also industry insights, connections, and potential customer bases. In contrast, financial investors are primarily focused on the financial returns, often with a shorter term perspective on exit strategies. Both bring valuable assets to the table, but the alignment of the startup's needs with the type of investor it attracts can significantly influence its growth trajectory and strategic direction. Absolutely, Alex. You've nailed the basic distinctions. I'd add that strategic investors can sometimes inadvertently steer a startup away from broader market opportunities due to their focus on specific synergies. On the other hand, financial investors, while less equipped to offer operational or sector specific guidance, often push for scalable, innovative solutions that aren't limited to one existing business's ecosystem, potentially opening up more diverse avenues for growth. It's crucial for startups to balance these perspectives to avoid becoming too niche or too scattered in their approach.
You've both highlighted key insights effectively. It's crucial for startups to weigh the pros and cons of each investor type carefully. Aligning with strategic investors can offer deep industry integration, while financial investors might drive broader market reach and innovation. The right choice depends heavily on the startup's current needs and long-term vision.
Let's discuss an interesting business topic: common mistakes founders make when pitching to investors. What are your thoughts on this?
Absolutely, Alex. One frequent misstep I've noticed is founders not fully understanding their target market size and dynamics, which can raise doubts about the scalability of their business model. Another common issue is when they focus too much on the product features without clear articulation of the customer pain points they're solving, which is crucial for showing the product's market fit and potential demand. These elements are vital for us to assess the viability and growth potential of their business.
Those are solid points, Morgan. Additionally, I often see founders underestimate the importance of presenting a realistic financial model. This includes not only how they will generate revenue, but also detailed projections and the assumptions behind them. A thorough financial plan shows us that a founder has a strong grasp on the mechanics of their business and is prepared for various scenarios, which is crucial for building investor confidence.
Absolutely. Those are pivotal insights. A common thread in these mistakes is a lack of clarity and depth in understanding both the market and their own business model. Founders must remember that a successful pitch is not just about showcasing a great product, but demonstrating a viable, scalable business strategy that addresses real customer needs and has solid financial grounding.
Let's discuss an interesting business topic: The role of traction metrics in early-stage fundraising. What are your thoughts on this?
Traction metrics are crucial, especially for early stage startups, as they provide tangible proof of market demand and the startup's growth potential. These metrics not only validate the business model, but also play a significant role in reducing investment risks. They essentially act as a litmus test, showing us how well the startup is resonating with its target market. Absolutely, Alex. Traction metrics do serve as crucial indicators. However, I think it's important to also look beyond the numbers. For instance, understanding the context in which these metrics were achieved, such as market conditions or initial user acquisition strategies, can tell us much more about the startup's potential longevity and adaptability. In some cases, an overemphasis on early traction can lead investors to overlook deeper structural issues that might impede long term success.
Absolutely. Both points are vital. Traction metrics are indispensable for gauging immediate market fit and growth potential, but they should be contextualized within the broader strategic vision of the company. It's crucial to balance these metrics with a thorough understanding of the startup's underlying business model and market dynamics to make informed, holistic investment decisions.
Let's discuss an interesting business topic: common mistakes founders make when pitching to investors. What are your thoughts on this?
Absolutely, Morgan. One frequent misstep I see is founders not clearly articulating how their solution differentiates from competitors. It's crucial to pinpoint your unique value proposition right off the bat. Additionally, overly optimistic financial projections without realistic justifications can be a red flag. It shows a lack of understanding of the market and an undermined credibility.
Absolutely, Philip. To build on your point, founders must strike a balance between vision and realism, ensuring that their pitches are grounded in solid, understandable metrics and achievable milestones is just as important as showcasing innovation. This not only boosts credibility, but also significantly enhances their appeal to potential investors like us.
Let's discuss an interesting business topic: why VCs are increasingly interested in healthcare and biotech. What are your thoughts on this?
Absolutely, Philip. The growing interest in healthcare and biotech among VCs largely stems from the significant advancements in technology and an increasing demand for personalized medicine. These sectors promise revolutionary changes in how we treat diseases, which not only has a profound social impact, but also offers substantial financial returns due to high margins in successful healthcare innovations. Plus, the global nature of health challenges ensures a wide market, making investments in these areas particularly attractive.
Morgan, you've hit the nail on the head. The convergence of technological advancements and increasing market demand makes healthcare and biotech not just a noble investment, but a strategically sound one, promising both significant returns and societal impact. This alignment of ethical investment and profitability fuels our growing interest in these sectors. Let's discuss an interesting business topic: trends in startup acquisitions versus IPOs. What are your thoughts on this?
Philip, that's a crucial topic. Lately, we're seeing a shift where more startups are opting for acquisitions over IPOs, primarily due to the high costs and regulatory hurdles associated with going public. However, while acquisitions can offer quicker liquidity and less public scrutiny, they often come with their own set of challenges, such as integration issues and potential culture clashes. It's essential for startups to weigh these paths carefully, considering their long term vision and operational readiness.
Riley, you've touched on key points. I'd add that the current market volatility is also steering startups towards acquisitions as a safer exit strategy. However, it's crucial for startups to not just look at the immediate benefits, but also consider how an acquisition might impact their innovation trajectory and growth potential. Often being absorbed by a larger entity can stifle the innovative spirit that initially drove the startup's success.
Both Riley and Morgan have highlighted significant aspects of the acquisition versus IPO debate. It's clear that while acquisitions can provide a quicker path to liquidity, there are considerable strategic considerations that need to be taken into account. Startups must balance immediate financial gains against long-term growth and innovation potential to truly decide the best route forward. Let's discuss an interesting business topic, the growing importance of AI in due diligence. What are your thoughts on this?
Philip, I completely agree that AI is becoming essential in due diligence processes. It not only speeds up the analysis of large data sets, but also enhances the accuracy of our risk assessments. However, we must be vigilant about the ethical implications and ensure transparency in how AI tools are utilized to maintain trust in our investment decisions.
Philip, Alex, your points are spot on. The incorporation of AI significantly streamlines the vetting process, allowing us to delve deeper into predictive analytics and scenario modeling, which are crucial for assessing long-term viability and risk. However, it's critical to establish robust frameworks for AI governance to avoid biases and ensure that the AI systems are not just black boxes, but tools whose processes and decisions can be understood and trusted by all stakeholders involved.
Absolutely. Alex and Morgan have both highlighted crucial aspects. Embracing AI in due diligence not only refines our efficiency and accuracy, but also demands rigorous ethical oversight and transparency. Ensuring these systems are understandable and trustworthy is fundamental to their successful integration into our decision-making processes.
Let's discuss an interesting business topic, the rise of alternative funding models like revenue-based financing. What are your thoughts on this?
Revenue based financing is a refreshing twist on startup funding, offering a more accessible option for businesses that might not fit the traditional VC model. It aligns the interests of investors and founders effectively, as repayments are tied to company performance, reducing the pressure for rapid, often unsustainable growth. However, it's crucial to scrutinize the fine print. Rates and caps can vary significantly, and not all models will suit every business type.
Riley, you've made some excellent points about the adaptability and founder-friendly aspects of revenue-based financing. It's indeed crucial for both founders and investors to closely examine the terms to ensure they align with the business's growth trajectory and financial health. This model could democratize access to capital, especially for non-traditional businesses that maintain steady revenue streams but may not promise unicorn-like growth.
Let's discuss an interesting business topic: why product led growth is becoming the dominant GTM strategy. What are your thoughts on this?
Product-led growth, PLG, is compelling because it leverages the product itself as the primary driver of customer acquisition, conversion, and expansion. This strategy can significantly reduce the cost of sales and marketing, making it highly efficient for scaling, especially in SaaS and other tech-driven markets. However, it's crucial for companies adopting PLG to invest heavily in making the product intuitive and ensuring it delivers real value quickly to foster user adoption and retention.
Absolutely, Philip. Product-led growth not only optimizes costs, but also aligns directly with customer satisfaction and retention by focusing on the intrinsic value of the product. For startups, this approach can be a game changer, provided they continuously innovate and listen to user feedback to enhance the product experience. This keeps the growth organic and sustainable.
Let's discuss an interesting business topic, the difference between strategic and financial investors. What are your thoughts on this?
Absolutely, Morgan. A strategic investor often comes from within the industry and aims to add value beyond capital, leveraging their network, resources, and expertise to drive the business forward. In contrast, a financial investor is primarily focused on the financial returns and may not necessarily have industry specific insights. Both play crucial roles, but aligning with the right type can significantly influence a startup's trajectory and how they scale.
Indeed, Alex hit the mark on the core differences. To add to that, strategic investors can sometimes influence a startup's direction more heavily, aligning it closely with their own business strategies, which can be both a boon and a bane depending on the strategic goals. On the other hand, financial investors typically offer a cleaner exit strategy, which can be attractive to founders looking to maintain operational control while still benefiting from capital infusion. It's crucial for startups to consider what they most need: guidance and integration into a larger ecosystem, or purely financial support to scale their operations independently.
Absolutely, Alex and Philip have both outlined key distinctions effectively. It's essential for startups to deeply consider whether they need a partner who will guide them strategically and potentially integrate their operations into a larger framework, or if they need an investor who is more hands-off but focused on maximizing financial returns. This decision can fundamentally shape their growth trajectory and how they achieve their business objectives.
Let's discuss an interesting business topic, the rise of alternative funding models like revenue-based financing. What are your thoughts on this?
Revenue-based financing is a compelling alternative for startups, particularly those in the SaaS or subscription-based sectors where revenue streams are predictable but perhaps not yet robust enough for traditional loans. It allows founders to retain more equity while aligning repayment with their growth, which can be less dilutive and more sustainable in the long run. However, startups must manage their cash flows carefully to avoid the pitfalls of overcommitment on their revenues, which can stifle flexibility and long-term strategic options.
Indeed, Philip makes a good point regarding the suitability of revenue-based financing for predictable subscription-driven models. However, I'm cautious about its broader applicability. Many sectors don't have the regularity of cash flows that SaaS businesses do, which can lead to strained financial operations if revenue predictions aren't met. It's crucial for startups considering this route to not only understand, but also realistically forecast their growth trajectory and revenue consistency. Philip and Riley both provide crucial insights into the strengths and limitations of revenue-based financing. It's essential for founders to carefully assess their business model's compatibility with this funding structure, ensuring they have the predictable, steady revenue streams necessary to support such commitments without hindering their operational agility or long-term growth prospects. Let's discuss an interesting business topic: the growing importance of AI in due diligence. What are your thoughts on this?
I think the integration of AI into due diligence is a significant shift. It allows us to process vast amounts of data at unprecedented speeds, which can drastically cut down the time and resources needed for market assessment and risk analysis. However, we must remain cautious about over-relying on AI without understanding the nuances and potential biases in the data it processes. This balance is crucial to maintaining the integrity and depth of our due diligence process.
Morgan, you've hit the nail on the head. AI indeed offers transformative potential in streamlining due diligence, but balancing this technology with critical human oversight is essential to ensure we're not just efficient, but also accurate and fair in our evaluations. This hybrid approach will likely define the future standard in our industry. Let's discuss an interesting business topic: how Web3 and blockchain are changing venture capital. What are your thoughts on this? Web3 and blockchain certainly present intriguing possibilities for venture capital, particularly in terms of decentralization and transparency in investments. However, it's crucial to temper our enthusiasm with a dose of skepticism. Many projects in this space are still in their infancy and lack proven business models or clear paths to profitability, which raises concerns about their long term viability. As always, due diligence is key when navigating these hyped sectors. Riley, you've hit the nail on the head. While the potential for innovation in venture capital through Web3 and blockchain is immense, it's essential to approach these technologies with a balanced view. Their real value will emerge as we see more sustainable and scalable models proving their worth in the market. Let's keep a keen eye on how these technologies evolve and impact our investment strategies moving forward.
Let's discuss an interesting business topic: when founders should bootstrap versus seeking venture funding. What are your thoughts on this?
Morgan, that's a critical decision point for founders. Bootstrapping is ideal when the business model allows for organic growth and can reach sustainability without the pressure of scaled operations early on. However, venture funding becomes crucial when the business is in a high growth industry where speed to market and significant upfront investment in technology or talent are necessary to establish a competitive edge. Essentially, the choice hinges on the market dynamics and the scale of the opportunity at hand. Morgan, Alex, you both raise valid points. In my experience, I often lean towards bootstrapping when a founder can use it as a proof of concept phase, particularly in markets not dominated by first mover advantages. Venture funding should indeed be pursued when the scale and speed are imperative, but it's also crucial when the business faces substantial barriers to entry that only significant capital can overcome. This strategic decision often defines the trajectory and the very nature of the company going forward.
Both of you have outlined key considerations effectively. The decision to bootstrap or seek venture funding should be strategically aligned with the company's market environment, competitive dynamics, and long-term growth objectives. Founders must meticulously evaluate their business's unique needs and trajectory to make an informed choice that optimizes their chances for success and sustainability.
Let's discuss an interesting business topic: the rise of micro VCs and solo capitalists. What are your thoughts on this?
The rise of micro VCs and solo capitalists is quite intriguing. They bring agility and a personal touch to investments that larger firms can sometimes miss. However, my concern is whether these smaller entities can sustain long-term growth and support their startups through scaling challenges, given their limited capital pools and networks compared to larger VCs.
Morgan, you've raised a valid concern. However, the agility and personalized attention of micro VCs and solo capitalists often allow them to spot and nurture early stage innovation more effectively, potentially leading to outsized returns despite their smaller scale. Their challenge will be to strategically leverage their unique strengths while finding innovative solutions to the scaling and network limitations you mentioned. Let's discuss an interesting business topic: the rise of alternative funding models like revenue based financing. What are your thoughts on this?
Alex, the rise of alternative funding models such as revenue-based financing is intriguing, especially for businesses with consistent revenue streams, but perhaps not enough assets for traditional loans. This model aligns the interests of investors and business owners more closely, as repayments are tied to monthly revenues. However, it does raise questions about scalability and the pressure it can put on cash flow, particularly in businesses with high revenue volatility.
Morgan, you've highlighted crucial points. Revenue based financing certainly offers a flexible alternative for businesses, aligning repayment with actual performance, which can be particularly attractive for startups and SMEs. However, the concerns about scalability and cash flow pressures are valid and need careful consideration to ensure this model supports sustainable growth rather than creating financial strain. Let's discuss an interesting business topic: why VCs are increasingly interested in healthcare and biotech. What are your thoughts on this?
Absolutely, Alex. The increasing interest from VCs in healthcare and biotech can largely be attributed to the sector's robust growth potential and resilience against economic downturns. Additionally, advancements in technology and personalized medicine are creating new investment opportunities that weren't available before. As these fields continue to evolve, They not only promise substantial financial returns, but also offer the potential for significant societal impact, which is increasingly important for modern investors.
Morgan, you've hit on key points there. I'd also add that the aging global population is a critical driver for the escalating VC interest in healthcare and biotech. This demographic shift increases demand for healthcare innovations, particularly in biotechnology and age-related diseases, providing a fertile ground for startups to innovate and scale. Moreover, the regulatory environment is evolving to favor faster approvals for breakthrough therapies, reducing time to market and enhancing investment attractiveness.
Morgan and Philip, you've both outlined compelling reasons for the heightened VC interest in healthcare and biotech. The convergence of technological innovation, demographic trends, and an evolving regulatory landscape indeed makes this sector ripe for impactful investments. This is not just about financial returns, it's about fundamentally improving lives, which adds a valuable dimension to our investment strategies. Let's discuss an interesting business topic: common mistakes founders make when pitching to investors. What are your thoughts on this?
Absolutely, Riley. One of the most frequent mistakes I see is founders not clearly articulating their unique value proposition and how it differentiates from competitors. They often focus too much on the product features without tying them back to actual market needs and measurable impact. Another common issue is the lack of a well-defined path to profitability, especially in pitches that overly emphasize growth metrics without detailing sustainable unit economics. It's crucial for founders to balance their vision with practical, data-driven plans that convince us of their long-term viability.
Absolutely, Morgan. To add to that, founders often underestimate the importance of directly addressing potential investor concerns, like market entry barriers and competitive landscapes, in their pitches. A pitch that anticipates and answers these concerns head on always stands out. It's about showing us not just why your product is great, but why it will succeed in the real world.
Let's discuss an interesting business topic: why product-led growth is becoming the dominant GTM strategy. What are your thoughts on this?
Philip, you're spot on about the rise of product-led growth, PLG. It's increasingly dominant because it aligns perfectly with customer-centric markets. Users can directly engage with the product, delivering faster feedback loops and organic growth through actual user satisfaction and word of mouth. This method not only reduces cost per acquisition, but also scales efficiently as satisfied users propel the product forward by becoming advocates.
Alex, you've highlighted key advantages of PLG effectively, especially regarding user engagement and organic growth. However, it's crucial to remember that PLG demands an exceptionally high-quality product that can stand out in competitive markets without substantial marketing spend. Startups adopting this strategy must focus intensely on product development and user experience to ensure the product itself can drive adoption and retention, which is a significant undertaking.
Alex and Morgan, you both make compelling points about the strengths and demands of product-led growth. It's clear that while PLG can dramatically enhance scalability and reduce customer acquisition costs, it requires a relentless focus on product excellence and user experience to truly succeed. This strategy isn't just about having a great product, it's about having a product that's so good it markets itself. Let's discuss an interesting business topic, the role of traction metrics in early-stage fundraising. What are your thoughts on this?
Philip, I think traction metrics are vital, but can be a double-edged sword. They provide a tangible way to gauge progress and potential, which is crucial for investors. However, overemphasis on early metrics can sometimes mislead, as they may not fully capture long-term viability or market potential. It's essential to balance these metrics with a solid understanding of the product market fit and the team's ability to execute and adapt. Riley, you make an excellent point about the potential misdirection from early traction metrics. From my experience, it's crucial to look beyond just the numbers. I focus on how these metrics reflect the startup's ability to create and sustain network effects, which are often a stronger predictor of long-term success in consumer tech. Metrics should be a starting point, not the whole story, and understanding the nuances behind them is key to evaluating a startup's future potential.
Riley and Alex, you both highlight critical perspectives. Traction metrics, while indispensable for assessing early-stage progress, should be contextualized within the broader narrative of the startup's strategic direction and market dynamics. It's the blend of quantitative data and qualitative insights that often provides the most accurate forecast of a startup's potential.
Let's discuss an interesting business topic: why product-led growth is becoming the dominant GTM strategy. What are your thoughts on this?
Morgan, you're spot on about the rise of product-led growth, PLG. It's primarily because PLG leverages the product itself as the main driver of customer acquisition, conversion, and expansion. This strategy not only reduces the cost of sales, but also allows for rapid scaling, especially in markets where users expect to try before they buy. From a financial perspective, it's a more efficient model that can lead to faster revenue growth and higher profit margins when executed well.
Philip, you've highlighted some core strengths of PLG, but it's crucial to remember that it isn't a one-size-fits-all strategy. It works best for products that can quickly demonstrate value without heavy personalization or extensive customer education. In sectors where the product needs significant customization or where the customer journey is complex, a more traditional sales-led approach might still reign supreme. We need to be cautious about adopting PLG universally without considering the specific market and product nuances.
Philip and Riley, you both make compelling points. PLG's efficiency in customer acquisition and scalability is undeniable. However, its applicability varies significantly across different markets and product complexities. As investors, it's essential we evaluate not just the attractiveness of PLG as a model, but also its fit with the specific business context we are considering. Let's discuss an interesting business topic: why VCs are increasingly interested in healthcare and biotech. What are your thoughts on this?
Absolutely, Morgan. The growing interest in healthcare and biotech among VCs can largely be attributed to the significant technological advancements and the increasing demand for personalized medicine. Moreover, the potential for high returns is attractive, especially given the aging global population and the continuous need for innovative healthcare solutions. However, it's crucial to remain cautious and discerning, as the hype can often overshadow the practical and scalable application of these technologies.
Riley, you've hit on key points. Additionally, the COVID-19 pandemic has accelerated digital transformation in healthcare, making tech integration more critical than ever. This has opened up new investment opportunities in areas like telemedicine, AI diagnostics, and biotech innovations. However, we must also be mindful of the regulatory challenges that can affect the scalability and adoption of new technologies in this space. It's not just about the potential for high returns, but also navigating these complexities effectively.
Absolutely. Riley and Philip have outlined the compelling reasons behind the surge in VC interest in healthcare and biotech. The blend of high return potential and significant technological advancements presents a unique opportunity. However, the importance of thorough due diligence cannot be overstated. Understanding regulatory landscapes and the actual scalability of innovations is crucial to making informed and successful investments in this sector.
Let's discuss an interesting business topic: why VCs are increasingly interested in healthcare and biotech. What are your thoughts on this?
Riley, there are a couple of compelling reasons for this trend. Firstly, the healthcare and biotech sectors are ripe for innovation, especially with advances in technology like AI and personalized medicine, which can potentially offer high returns on investment. Secondly, these sectors are somewhat recession-proof. People always need healthcare, making these investments more stable and attractive in uncertain economic times.
Absolutely, Morgan. You've nailed some key points. Additionally, the aging global population presents a growing market for healthcare and biotechnology services, driving demand and potentially lucrative opportunities for innovation in longevity and age-related therapies. This demographic shift, combined with the technological advancements you mentioned, creates a fertile ground for VCs looking to invest in sustainable, impactful ventures that also promise substantial financial returns.
Absolutely. Both of you have outlined critical reasons why healthcare and biotech are magnet sectors for VC investment. It's also worth emphasizing the regulatory shifts and increased government funding that are lowering barriers and fueling innovation, making these sectors not only necessary, but increasingly viable for high impact investments. The convergence of necessity, innovation, and demographics makes a compelling case for VC attention here.
Let's discuss an interesting business topic: why VCs are increasingly interested in healthcare and biotech. What are your thoughts on this?
Certainly, Morgan. The healthcare and biotech sectors are ripe for innovation, particularly with the advent of AI and personalized medicine. VCs are drawn to the substantial return potential given the ever-growing demand for healthcare solutions and the global aging population. Moreover, these sectors often offer technological and regulatory barriers that can provide a sustainable competitive advantage to successfully developed ventures.
Morgan, Phillip, both of you make valid points about the potential returns and barriers that make healthcare and biotech attractive. However, I'm cautious about the current hype. The regulatory and development risks are substantial, and the path to market is often longer and more complex than anticipated. As VCs, we need to ensure we're not just following trends, but also deeply understanding the intricacies and genuine innovation potential in these sectors.
Philip and Riley, you've both highlighted critical aspects of the growing interest in healthcare and biotech. It's evident that while the promise of high returns and strong barriers to entry make these sectors appealing, we must balance our enthusiasm with rigorous due diligence to mitigate the inherent risks and complexity. As VCs, our goal should be to foster genuinely innovative solutions that address real-world health challenges effectively and sustainably.
Let's discuss an interesting business topic: the rise of micro VCs and solo capitalists. What are your thoughts on this?
Riley, it's a fascinating shift, indeed. Micro VCs and solo capitalists are injecting much needed agility and personalization into the venture space. They often take risks on niche or early stage projects that larger firms might overlook, which can lead to innovative breakthroughs. However, the challenge remains in scaling their investments and maintaining high quality deal flow as they grow.
Philip, you've highlighted key strengths of micro VCs and solo capitalists. Their agility allows them to move quickly and make decisions without the cumbersome processes that can slow down larger firms. However, my main concern centers on their long-term sustainability and risk management. Without the diversified investment portfolio that larger firms typically maintain, micro VCs and solo capitalists might face higher volatility in returns. This could particularly impact their ability to weather economic downturns or failed investments.
Philip and Morgan, you both make compelling points about the practical agility and potential limitations of micro VCs and solo capitalists. It's clear that while they fill a crucial gap in funding innovation and taking bold risks, their challenge will be in crafting strategies that balance their nimble advantages with the sustainability needed to thrive long term. This balance could indeed redefine their roles and impacts in the broader venture ecosystem. Let's discuss an interesting business topic: how Web3 and blockchain are changing venture capital. What are your thoughts on this?
Absolutely, Alex. Web3 and blockchain are indeed reshaping VC by enhancing transparency and streamlining transactions. The technology allows for smart contracts and decentralized funding models, which could potentially reduce overhead costs and speed up the investment process. However, it's critical to approach with caution as the regulatory landscape is still evolving and the long-term viability of many Web3 projects remains uncertain. We need to focus on fundamental business metrics and clear paths to profitability, even in this innovative space.
Absolutely, Morgan. Your points are well taken. The promise of Web3 and blockchain to transform venture capital is clear, particularly in terms of efficiency and transparency. However, as we proceed, it's crucial to balance our enthusiasm for new technologies with rigorous due diligence, ensuring that innovation does not eclipse the foundational principles of solid investment strategy. Let's discuss an interesting business topic: trends in startup acquisitions versus IPOs. What are your thoughts on this?
Riley, that's a timely topic. Lately, we've seen a significant tilt towards acquisitions, mainly because they offer a quicker exit strategy and less public scrutiny compared to the IPO route. However, IPOs can still be attractive for startups seeking not just capital, but also a higher profile and market credibility. It's crucial for startups to really understand their long-term business goals and market positioning before deciding the best exit strategy.
Absolutely, Morgan. The choice between acquisition and IPO deeply hinges on a startup's strategic vision and its readiness for the demands of public markets. It's essential they weigh these options not just for immediate gains, but in alignment with their long term growth and operational ambitions.
Let's discuss an interesting business topic: the rise of micro VCs and solo capitalists. What are your thoughts on this?
Morgan, the rise of micro VCs and solo capitalists is quite fascinating. They bring agility and a personal touch to the investment landscape, often capable of making swift decisions and nurturing close relationships with founders. However, their challenge lies in scaling their influence and maintaining high quality deal flows amidst intense competition from larger firms. Absolutely, Riley. The agility of micro VCs and solo capitalists is indeed a game changer, particularly for early stage startups needing rapid, adaptive investment decisions. However, their long term impact hinges on their ability to leverage networks effectively. They need to build robust ecosystems around their investments to create the kind of network effects that can rival those of larger firms, ensuring they can offer not just capital, but substantial growth support to their portfolio companies.
Riley and Alex, you've both highlighted key strengths and challenges facing micro VCs and solo capitalists. Their personalized approach and rapid decision-making are invaluable, especially for early-stage ventures. Yet their success will largely depend on their ability to scale personal relationships into larger, sustainable networks that can support growth and attract continuous, quality deal flow amidst stiff competition. Let's discuss an interesting business topic: why VCs are increasingly interested in healthcare and biotech. What are your thoughts on this?
Morgan, the growing interest in healthcare and biotech among VCs isn't surprising. These sectors offer transformative potential with high risks, but equally high rewards, especially given the aging global population and the continuous need for medical innovation. Additionally, the pandemic has accelerated digital health trends, making this space ripe for technological disruption, which is a magnet for venture capital looking for scalable opportunities.
Absolutely, Riley. The convergence of high stakes and high impact, along with technological advancements, positions healthcare and biotech as key sectors for venture capital. It's not just about the potential financial returns, but also the opportunity to profoundly affect global health outcomes.
Let's discuss an interesting business topic: why product led growth is becoming the dominant GTM strategy. What are your thoughts on this?
Riley, you're spot on highlighting product led growth as a dominant trend. It's primarily because PLG not only reduces the cost of customer acquisition significantly, but also leverages the product itself as the main vehicle for market penetration. This strategy empowers users to see the value of the product firsthand, enhancing user acquisition, retention, and ultimately revenue growth, all critical elements for sustainable scalability in today's fast-paced markets.
Philip, you've outlined the core advantages of PLG well. However, it's crucial to remember that while PLG can dramatically drive growth and reduce costs, it requires a product that inherently solves a significant problem or improves an existing solution substantially. Companies must focus intensely on product quality and user experience to truly leverage PLG effectively. Let's discuss an interesting business topic: why most SaaS startups fail in their first 2 years. What are your thoughts on this? Riley, that's a crucial topic. In my view, many SaaS startups fail initially because they don't achieve product market fit before scaling. They might focus heavily on the tech, but neglect the equally vital parts of customer discovery and validation. Additionally, underestimating the importance of a strong go to market strategy can leave them struggling to gain traction amidst fierce competition. Alex, you've hit the nail on the head. A common thread in these failures is indeed the rush to scale without a solid foundation in product market fit and a viable go to market strategy. SaaS startups need to balance their innovation zeal with rigorous market validation to truly succeed. Let's discuss an interesting business topic: why product led growth is becoming the dominant GTM strategy. What are your thoughts on this?
Absolutely, Alex. Product led growth is gaining traction primarily because it allows companies to scale quickly and efficiently by focusing on the product itself to drive user acquisition, conversion, and expansion. It's particularly effective in the SaaS industry, where the product can often sell itself through free trials or freemium models, reducing the need for heavy sales teams and allowing companies to allocate resources more towards innovation and development. This self-serving model can significantly lower customer acquisition costs and increase lifetime value if the product is designed to meet market needs effectively.
Philip, you've touched on some critical points, especially about cost efficiency and customer acquisition. However, it's crucial to emphasize that product-led growth also demands a product that not only attracts users, but retains them through exceptional user experience and value. If the product fails to meet these criteria, even the best go-to-market strategy can falter. Moreover, while it reduces upfront sales costs, it increases the pressure on product development and support to continuously innovate and address user issues swiftly. This approach isn't a one-size-fits-all, but can be transformative in the right contexts.
Absolutely. Both Philip and Morgan have highlighted critical aspects of why product led growth is surging as a preferred GTM strategy. It's essential, however, to recognize that while this approach can drive substantial scalability and efficiency, its success fundamentally hinges on the continuous evolution of the product to meet and exceed user expectations. This strategy shines brightest when aligned with robust feedback loops and agile development practices that quickly iterate on user input.
Let's discuss an interesting business topic: why some unicorns fail despite massive funding rounds. What are your thoughts on this?
Philip, that's a great topic. Often these unicorns suffer from a lack of focus on sustainable unit economics. They prioritize growth over profitability. Massive funding can sometimes create complacency, leading to inefficient capital allocation and underestimation of operational challenges. The key is maintaining a balance between growth and a clear path to profitability, which is not always straightforward in the high-stakes environment that unicorns operate in.
Absolutely, Morgan. It's crucial for startups, especially those with significant funding, to remember that while rapid expansion is appealing, it must be strategically managed to ensure long-term sustainability. Keeping a vigilant eye on the fundamentals, like unit economics and efficient capital use, is essential to avoid the pitfalls that have ensnared others in the past.
Let's discuss an interesting business topic: the growing importance of AI in due diligence. What are your thoughts on this? Absolutely, Alex. AI's role in due diligence is becoming a game changer, particularly in automating the tedious elements of data verification and risk assessment. However, I'm cautious about over reliance on AI without adequate oversight. It's crucial to maintain a balance where human judgment is not completely overshadowed by algorithms, especially in complex scenarios where contextual and nuanced understanding is vital. Riley, you've hit the nail on the head. As we integrate AI further into due diligence processes, ensuring a synergistic balance between AI capabilities and human expertise will be crucial for maintaining both efficiency and accuracy. Let's continue to monitor and adapt to these advancements thoughtfully.
Let's discuss an interesting business topic: trends in startup acquisitions versus IPOs. What are your thoughts on this?
Philip, it's certainly a dynamic topic. Lately, we're seeing a more pronounced lean towards acquisitions, especially with larger companies looking to quickly assimilate innovative technologies and expand their market share. However, the allure of IPOs remains strong for startups aiming for higher valuations and public visibility. The key is really understanding the long term strategic fit rather than just the immediate financial gains. Riley, you've hit some key points. The shift towards acquisitions is often driven by big players wanting to hedge against disruption by absorbing innovative newcomers. However, while IPOs offer visibility and potentially higher valuations, they require a robust, scalable model that can withstand public market scrutiny. It's crucial for startups to consider their ultimate vision and the paths available to scale effectively, whether that means thriving independently or under the umbrella of a larger corporate entity.
Riley and Alex, you've both outlined critical perspectives well. It seems that the choice between acquisitions and IPOs hinges significantly on a startup's maturity, market readiness, and long term vision. Each path offers distinct advantages and challenges, and the decision must align with the startup's strategic goals and the realities of their operational capabilities.
Let's discuss an interesting business topic: how the funding environment has changed in the last year. What are your thoughts on this? Absolutely, Alex. Over the past year, we've seen a significant shift towards more cautious investment, with VCs really drilling down into unit economics rather than just growth metrics. There's also been a noticeable pivot towards sustainability and long term viability, rather than the previously favored growth at all costs model. This means that startups now need to present more robust, realistic financials and clearer paths to profitability right from the early stages.
I'm back. I'm just making a quick update. I realized that Cursor deleted a lot of the business topics that I had added to it, so they were repeating themselves for basically an hour and a half. They only had like 10 topics to go through, so it was kind of hard for them to manage. I really want this to be like a very long, thorough discussion, so I'm going to work on trying to get that implemented into the project. just deleted all those files. Sorry about that if you ended up watching this. I know nobody's joined, so I don't think so. You had one viewer in here for 31 seconds, but okay. I should have announced that I was going live with this a little earlier. All right. Save a GitHub before I tried this. All right, let's finish. Okay. Oh, this isn't what people signed up for. Yeah, I can take a break on YouTube. I forgot about that. Let me do that. Okay. So it looks like Cursor's made all the updates. I'm gonna try this out again. I might be back sooner than I want to be.
Absolutely, Alex. Over the past year, we've seen a significant shift towards more cautious investment with Hello, everyone. I'm Riley, and welcome to our AI Venture Capitalist panel stream. I'm looking forward to reviewing your startup pitches today. Submit your pitch via donation or channel points redemption, and our panel will provide feedback. Let's get started. Let's discuss an interesting business topic, the role of AI in the future of marketing and advertising. What are your thoughts on this?
Alex, I think AI's role in marketing and advertising is pivotal. It enables unprecedented levels of personalization and efficiency. However, the real value comes from integrating AI in a way that enhances user experience without compromising privacy. There's a fine line there, and successful companies will be those that navigate it skillfully while maintaining transparency with their users.
Philip, you've touched on a crucial point about privacy and user experience. In addition, I think the scalability that AI brings to data analysis and marketing cannot be overstated. It allows companies to understand and predict consumer behavior at scale, which can significantly drive down customer acquisition costs if leveraged correctly. However, startups must also focus on the robustness of their AI systems to avoid biases and ensure that the AI's decision-making process is transparent and explainable to consumers.
Philip and Morgan, you both highlight essential dimensions of AI's impact on marketing and advertising: personalization, privacy, scalability, and transparency. As we move forward, the successful integration of AI will hinge not only on technological advancement, but also on ethical implementation. Companies that balance innovation with consumer trust will set the industry standard and likely reap the most substantial benefits.
Let's discuss an interesting business topic: the future of work and the skills needed for success. What are your thoughts on this?
Morgan, the future of work is increasingly shifting towards flexibility and digital fluency, but I think there's a risk in overlooking soft skills such as adaptability, problem solving, and interpersonal communication. These skills will be essential as teams become more diverse and geographically dispersed. While tech skills are critical, the human element can't be underestimated in fostering innovation and maintaining a competitive edge.
Riley, I completely agree with your emphasis on soft skills. In my experience, startups that nurture both technical proficiency and soft skills like leadership and empathy tend to create more resilient and innovative teams. Additionally, as we look towards integrating AI more deeply into the workplace, the ability to work alongside and manage AI-driven systems is becoming an indispensable skill set. This blend of human creativity and technological understanding is where I see substantial competitive advantages emerging.
Riley and Philip, you both make compelling points about balancing technical skills with essential soft skills in the evolving workplace. As we move forward, successful startups will need to foster a culture that equally values technological acumen and the human-centric skills that drive teamwork and innovation. This holistic approach will likely be a key differentiator in a competitive, AI-enhanced future.
Let's discuss an interesting business topic: why most SaaS startups fail in their first 2 years. What are your thoughts on this?
Absolutely, Alex. A key reason many SaaS startups struggle is their underestimation of the market saturation and competitive intensity. Without a clear, compelling value proposition, they find it hard to differentiate themselves and gain traction. Additionally, there's often a misalignment between their pricing strategies and market expectations, which can severely hinder early growth and sustainability.
Absolutely, Philip. To add to that, the challenge also lies in building a robust user base quickly enough to benefit from network effects, which is crucial for SaaS platforms. Startups that can't engage a critical mass of users early on struggle to prove their long term viability, leading to their downfall in those initial years. Let's discuss an interesting business topic: the role of AI in the future of agriculture. What are your thoughts on this?
Absolutely, Riley. AI in agriculture is transformative, offering potential for substantial efficiency gains and precision in resource management. However, I see a critical need for startups to focus on scalability and data privacy, especially as they handle sensitive farming data. Ensuring these systems are robust and adaptable to various agricultural environments will be key to their success and adoption.
Philip, you've hit the nail on the head regarding scalability and data privacy. My added thought is on the user experience, specifically how these AI systems interface with farmers. For widespread adoption, these platforms must be intuitive and provide immediate value without a steep learning curve. Ensuring that the technology is accessible to farmers of all tech skill levels will be crucial for its success in diverse agricultural settings. Absolutely, Philip and Alex have covered the crucial aspects well. I'd emphasize that while AI's potential in agriculture is indeed promising, the key to success lies in its practical application. Let's not just chase the AI trend. Ensure that these solutions genuinely solve real world farming problems and are easily integrated into the daily routines of farmers. This approach will drive both adoption and long term impact.
Let's discuss an interesting business topic: understanding the process of taking a company public, IPO. What are your thoughts on this?
Absolutely, Morgan. Taking a company public is a significant milestone, but it's critical to ensure the business has robust fundamentals and a scalable model before considering an IPO. It's also essential to have a clear narrative for investors, demonstrating not just current value, but also long term growth potential. This helps in building investor confidence and can significantly impact the IPO's success.
Absolutely, Alex. A successful IPO hinges not just on strong fundamentals and investor narratives, but also on timing and market conditions. Companies must be meticulously prepared to navigate these complexities to maximize their IPO success and sustain long-term growth post-listing. Hi, Tuke 111. I'm Morgan. This is an innovative concept leveraging AI to scale feedback on business ideas.
Let's discuss an interesting business topic: the difference between strategic and financial investors. What are your thoughts on this?
Absolutely, Riley. A key difference is that strategic investors typically invest in companies that align with their own business model or industry, aiming to leverage synergies or enhance their core business. Financial investors, on the other hand, are primarily focused on achieving financial returns and may not necessarily have a long-term interest in the company's specific industry. They're more flexible, but sometimes less involved in shaping the company's strategic direction.
Philip, you've nailed the fundamental distinctions. I'd add that strategic investors often bring more than just capital. They can offer valuable industry connections, expertise, and operational support that can be crucial, especially in early stages. Financial investors, while sometimes perceived as less committed, do play a vital role in scaling, given their focus on optimizing financial structures and exits. Both types have their place, depending on the company's life cycle and needs. Philip and Alex, you've both highlighted essential distinctions well. It's crucial for entrepreneurs to understand these differences when seeking investment, as the right type of investor can dramatically influence both the trajectory and the very nature of their business. Strategic and financial investors do not just offer money, they bring a whole ecosystem of benefits and focuses, tailoring their involvement to what they seek to achieve.
Hi, Tuke 111. I'm Morgan. It seems like your pitch is quite brief and lacks detail, which makes it difficult to understand the core concept, target market, and potential applications of your product. To provide constructive feedback,
Let's discuss an interesting business topic: the future of AI in the automotive industry. What are your thoughts on this?
AI in the automotive industry is set to revolutionize not just how cars are driven, but how they are integrated into our daily lives. One critical area for investment is in AI-driven predictive maintenance, which could significantly reduce downtime and repair costs, providing a strong value proposition to consumers. However, we must be cautious about the regulatory and ethical implications, as these could greatly influence the pace and direction of AI integration in this sector.
Absolutely, Philip. While AI's potential to transform automotive efficiency and user experience is immense, navigating the regulatory frameworks will be critical. Our focus should be on supporting innovations that not only push technological boundaries, but also prioritize safety and compliance to shape a sustainable future in the automotive industry. Let's discuss an interesting business topic: the metaverse. Hype or the next big platform for businesses? What are your thoughts on this?
I lean towards seeing the metaverse as the next big platform, albeit with an asterisk. The potential for immersive, interconnected virtual experiences is vast, particularly in industries like retail, education, and remote work. However, its success hinges significantly on technological advancements, user adoption rates, and clear, sustainable monetization strategies. Without these, it risks remaining more speculative hype than transformative platform.
Philip, I agree with your cautious optimism. The key to the metaverse transitioning from hype to a significant business platform will indeed be its ability to build robust network effects. Creating a seamless, user friendly environment that not only attracts users but also retains them by delivering continuous value will be crucial. We should look for startups that are not just jumping on a trend, but are genuinely innovating on how to connect users and create engaging, valuable experiences that can scale. While the potential of the metaverse is intriguing, the real litmus test will be its practical application across various sectors and its ability to evolve from a niche novelty into a mainstream necessity. Let's focus our investments on companies that demonstrate clear, actionable plans for integration and scalability rather than just capitalizing on the current buzz. Let's discuss an interesting business topic: when founders should bootstrap versus seeking venture funding. What are your thoughts on this?
Riley, that's a crucial topic. In my view, Bootstrapping is ideal for founders who can sustain growth through internal cash flow, particularly when their business model allows for gradual scaling or when preserving equity and control is paramount. Conversely,
Me again. Um, I noticed that they weren't processing pitches that I submitted, or at least they were. They noticed them, but then they were getting cut off by some of the agents. So, trying to work through that in Cursor. I wanted this to run for a solid couple hours, and if anybody happened to join, then it'd be nice if their pitches could at least be responded to. So I'm just rambling. Might as well have recorded this if it doesn't respond to people. I shut it off because it was testing. Yeah, it's running through tests. So keeps on getting stuck on Python commands. I don't know why. It keeps auto switching to the other screen. I'm just chilling here, waiting for cursor to do its thing. Stuck on CD, what the hell?
Hello, everyone. I'm Alex, and welcome to our AI Venture Capitalist panel stream. I'm looking forward to reviewing your startup pitches today. Submit your pitch via donation or channel points redemption, and our panel will provide feedback. Let's get started. Let's discuss an interesting business topic: the rise of alternative funding models like revenue based financing. What are your thoughts on this?
Revenue-based financing is intriguing, particularly for businesses with predictable revenue streams, but perhaps not the exponential growth trajectory expected by traditional VC models. It's less dilutive for founders, which is a huge plus. However, the cost of capital can be higher, and it demands mature financial operations to handle the revenue share payments effectively. This model might not fit all startups, but certainly fills a niche that traditional equity financing doesn't always address.
Philip, you've touched on key points about revenue-based financing. It's particularly compelling for SaaS businesses, where revenue predictability is higher. However, startups need to be wary of the cash flow implications. Diverting a portion of revenue to repayments can strain operations, especially during downturns. This model demands a thoroughly vetted financial strategy to ensure sustainability beyond the immediate non-dilutive benefits.
Philip and Morgan, you've both highlighted essential considerations. Revenue based financing indeed offers an attractive alternative for certain business models by aligning funding costs directly with revenue performance, thereby reducing founder dilution and aligning investor and founder interests. However, its suitability largely depends on the predictability of revenue and the robustness of financial management within the company. It's crucial that startups evaluate their long term financial health and growth trajectory critically when considering this model.
Hi, TUS 101. I'm Philip. The concept of a dog nail salon is certainly niche and caters to pet owners who prioritize grooming. However, I have a few concerns about scalability and market size. It's crucial to validate if there's sufficient demand beyond a small, high-income demographic. Additionally, consider the competitive landscape. Pet grooming services often include nail trimming as part of a broader offering. How will your salon differentiate itself? Will there be additional services or technologies that make your offering unique and indispensable? Financially, I'd recommend a detailed breakdown of initial setup costs, ongoing expenses, and projected revenue streams. Given the specialized nature of this service, a lean operational model could be effective, possibly starting with a pop-up or mobile service to gauge interest and expand based on data-driven metrics. Keep these factors in mind to strengthen your pitch. Hi, Tuk One Wenlen. I'm Philip. The concept of a hotel for fraud.
Let's discuss an interesting business topic: navigating the complexities of business taxation. What are your thoughts on this?
Morgan, that's a crucial topic, especially for startups looking to scale effectively. My view is that while tax complexities can be daunting, they also offer strategic opportunities for cost saving and government incentives. Startups should invest in knowledgeable partners or tools early on to navigate these waters smoothly, turning potential challenges into advantages.
Absolutely, Alex. Proactively managing taxation not only mitigates risks, but can indeed transform potential fiscal burdens into strategic benefits. Investing early in expert advice or efficient tools is essential for leveraging these opportunities and ensuring sustainable growth.
Let's discuss an interesting business topic: strategies for raising capital through debt financing. What are your thoughts on this?
Debt financing can be a robust strategy for startups, especially for those with predictable revenue streams and strong cash flow. However, it's crucial to balance the terms and the cost of debt carefully. Excessive leverage can jeopardize a company's financial stability, so I advise companies to evaluate their capacity to service debt comprehensively before committing. This approach minimizes the risk of compromising operational flexibility.
Absolutely, Philip. Your points are well taken.
Okay. It's fixing itself in cursor again. I think it's running another terminal. So kill this one. All right. I think I'm gonna clip that part where they're talking about the metaverse. That was kind of funny. Yeah. Great. That's funny. just stuck. Keeps getting stuck on Python commands. Okay. Let's hope this works. Try it in simulation mode first. How do I plan on this?
Hello, everyone. I'm Alex, and welcome to our AI Venture Capitalist panel stream. I'm looking forward to reviewing your startup pitches today. Submit your pitch via donation or channel points redemption, and our panel will provide feedback. Let's get started.
Hi, test user. I'm Morgan. This is an interesting concept, focusing on enhancing communication within corporate environments. However, there are a few critical areas that need clarity to better assess the potential of your startup. 1. Market need. Is there a substantial demand for this service? You'll need to provide evidence that corporate users are seeking solutions to decipher buzzwords significantly enough to pay for such a service. 2. Revenue model. How do you plan to monetize this? Is this a subscription-based model, a one-time purchase, or perhaps integrated as a feature within larger corporate communication tools? Understanding the revenue stream is crucial. 3. Differentiation. What makes your AI system stand out from existing communication tools or plugins that might include similar features? 4. Scalability. Can this product scale? Consider whether the appeal is broad enough across different industries and regions. Incorporating this feedback can strengthen your pitch and make a more compelling case to potential investors.
Hi, test user. I'm Alex. This is a fun and engaging concept, particularly useful for improving communication clarity in business settings. However, I'd like to understand more about how you plan to scale this idea. Translation tools are handy, but your product needs a clear path to widespread adoption. Consider integrating with popular communication platforms or corporate email systems to increase its usability and reach. Also, think about how you can create a network effect. Perhaps your platform could allow users to submit and verify translations, enhancing the system's accuracy and utility over time. This could also help in creating a more engaged user base. Lastly, what's your monetization strategy? Offering basic services for free while charging for premium features, or a subscription model for enterprises, could be viable. Overall, it's a clever idea, but needs a bit more development in terms of business application and scalability.
Okay, that was enough of that. That was the test uh, part of this simulation mode where it simulates users. Basically, saves me some embarrassment. At least I hope so. Let's try this.
Hi, test user. I'm Alex. This is a fun and engaging concept, particularly useful for improving communication clarity and. Hello, everyone. I'm Riley, and welcome to our AI Venture Capitalist panel stream. I'm looking forward to reviewing your startup pitches today. Submit your pitch via donation or channel points redemption, and our panel will provide feedback. Let's get started.
Let's discuss an interesting business topic, the future of AI startups and investment trends. What are your thoughts on this?
Morgan, while AI startups continue to attract massive attention and funding, I'm cautious about the bandwagon effect we're seeing. Many entrants lack distinct competitive advantages or clear paths to profitability, which is a red flag. My focus is on AI companies that carve out niche markets or enhance traditional industries in overlooked ways. Those are the ones that tend to bring real value and sustainable growth.
Riley, I agree with your cautious approach. It's crucial to prioritize AI startups that not only innovate but also demonstrate sustainable business models. Investing in companies with practical applications and strategic market positioning will likely yield the most enduring returns.
Let's discuss an interesting business topic: the impact of interest rates and inflation on startup valuations. What are your thoughts on this?
Certainly, Alex. Higher interest rates typically increase the cost of borrowing, which can dampen startup growth and subsequently lower valuations. Inflation, on the other hand, erodes purchasing power, which might lead startups to adjust prices, potentially impacting their customer base negatively. As VCs, we need to factor these elements into our valuation models, potentially adjusting our expectations for growth and profitability in more volatile economic conditions.
You both raise valid points about the macroeconomic factors affecting startup valuations. However, it's also worth noting that in times of high interest rates and inflation, startups with innovative solutions that address these economic pain points can actually see an uptick in valuation. As investors, we should look for companies that are not just resilient, but can leverage these conditions to gain a competitive advantage. Those that can turn challenges into opportunities often present the most attractive investment prospects. Morgan and Riley, you've both highlighted crucial considerations. Indeed, while macroeconomic factors like interest rates and inflation generally pose challenges, they also create a landscape where truly adaptive and innovative startups can distinguish themselves and thrive. As investors, our role is to discern these opportunities and support ventures that not only withstand but capitalize on these economic shifts.
Hi, Tuke111. I'm Morgan. Thanks for sharing your pitch on fat-burning coffee. To better evaluate, I need more details on a few key aspects. First, can you clarify the scientific basis behind the fat-burning claim? It's crucial that these claims are substantiated to avoid regulatory issues and to ensure consumer trust. Secondly, how do you plan to differentiate your product in the crowded health and wellness market, particularly against other caffeinated products that promise weight loss benefits? Moreover, I'd like to understand your target market more clearly. Who exactly are you marketing to, and how large is this segment? Finally, let's talk about unit economics. What's your cost of production versus your proposed selling price, and what are the projected margins? Understanding these will help assess the financial viability of your business model.
Hi 211, I'm Riley. An intriguing concept, but let's drill down on what sets your metaverse application apart from the crowded field of remote work solutions. The core value proposition needs to be crystal clear. How does your product enhance productivity or collaboration better than the existing tools which are already widely adopted and don't require users to engage in a fully immersive environment? Moreover, consider the accessibility barriers, such as the need for VR headsets, which might limit your user base. My advice is to focus sharply on specific pain points that are unique to your solution. Can you provide a feature that's a game changer and not just a novelty? That's what will make or break your product in a competitive market.
Let's discuss an interesting business topic: the impact of personalized medicine on the healthcare industry. What are your thoughts on this?
Personalized medicine is poised to revolutionize healthcare by making treatments more effective and reducing side effects. But the real challenge lies in scalability and data privacy. The technology and infrastructure costs are still prohibitive for widespread adoption. It's crucial for us to look at startups that not only innovate in the science, but also in making these solutions accessible and secure for a broader population.
Riley, you've pinpointed the crux of the matter. As we evaluate startups in this space, our focus should be on those that not only push the envelope in biomedical innovation, but also address the economic and ethical frameworks necessary for personalized medicine to be viable and impactful on a global scale. Scalability and privacy are indeed key hurdles that need to be overcome.
Let's discuss an interesting business topic: why most SaaS startups fail in their first 2 years. What are your thoughts on this?
Absolutely, Alex. A common issue I've noticed is that many SaaS startups struggle with customer acquisition and retention. They often underestimate the costs and challenges associated with these aspects, which can quickly deplete their capital. Moreover, their failure to differentiate in a crowded market leads to a lack of sustainable competitive advantage, making it hard to survive beyond the initial launch phase.
Philip, you've hit on crucial points. Another dimension to consider is that many SaaS startups falter because they don't fully understand their customers' journey or pain points, leading to a product market misfit. Additionally, their focus on rapid scaling often overshadows the need for a solid, adaptable foundational strategy, which is essential for enduring the inevitable shifts in market dynamics and customer preferences. This lack of strategic depth can be as detrimental as poor customer acquisition and retention strategies. Philip and Riley, you've both outlined critical factors beautifully. Indeed, the intersection of customer understanding and strategic agility seems to be where many SaaS startups stumble. Ensuring that these elements are prioritized from the outset could dramatically change the survival rates of new SaaS ventures. Let's discuss an interesting business topic: compliance requirements for different industries and sectors. What are your thoughts on this?
Compliance is indeed a critical area, particularly in heavily regulated industries like healthcare and finance. One important aspect to consider is the cost of compliance, which can be substantial and vary significantly across sectors. It's essential for businesses to not only understand these costs up front, but also to continuously innovate in compliance processes to maintain efficiency and reduce long-term expenses.
Absolutely, Morgan. Balancing the initial and ongoing costs of compliance is crucial, especially for startups aiming to disrupt traditional industries. Innovative compliance solutions can be a significant competitive advantage, potentially opening doors to new markets and investment opportunities. Let's discuss an interesting business topic: developing essential leadership skills for startup founders. What are your thoughts on this?
Alex, that's a crucial topic. Founders often underestimate the value of strong leadership skills, which are fundamental for guiding a team and making strategic decisions under pressure. I believe it's important for founders to not only focus on their product, but also invest time in developing soft skills like communication, empathy, and resilience, which significantly impact a startup's culture and success. What specific areas do you think are most crucial for founders to focus on?
Morgan, you've highlighted some essential points. I'd add that financial acumen is equally critical for founders. Understanding the financial implications of decisions, managing cash flow efficiently, and being able to communicate financial health to stakeholders, these are skills that directly impact a startup's ability to attract funding and scale. Additionally, strategic decision-making, which involves assessing market trends and aligning them with the company's vision, is indispensable for sustaining long-term growth.
Absolutely. Morgan and Philip have underscored vital aspects. While soft skills and financial acumen are essential, I'd stress the importance of adaptability and vision alignment. Founders must be flexible to pivot when necessary, but steadfast in their overarching vision to navigate through the inevitable ups and downs of startup life effectively. This balance is key to fostering both resilience and strategic growth. Let's discuss an interesting business topic: understanding convertible notes and safe agreements. What are your thoughts on this?
Absolutely, Riley. Both convertible notes and safe agreements are crucial instruments for early-stage startup funding, primarily because they allow for investment without immediately setting a valuation. Convertible notes, with their interest rates and maturity dates, offer a structured approach, while safes are simpler and potentially less costly for startups as they don't accrue interest. However, the choice between them should depend on the startup's financial stability, projected growth rate, and the investor's risk tolerance.
Morgan, you've outlined the basics well. I'd add that convertible notes might be more favorable from an investor's perspective due to the added protection of debt-like features, including interest and maturity dates. Safes, while simpler, shift more risk to the investor, as they only convert upon specific triggers, usually a future-priced funding round. It's crucial for startups to consider how these instruments can impact future financing rounds and investor relations.
Both Morgan and Philip have made excellent points. It's essential for startups to consider not only the immediate benefits, but also the long-term implications of choosing between convertible notes and safes. The decision should align with their financial trajectory and how they plan to build relationships with future investors. Ultimately, understanding and selecting the right financial instrument can be as strategic as any other business decision.
Let's discuss an interesting business topic: why product led growth is becoming the dominant GTM strategy. What are your thoughts on this?
Philip, I think product-led growth, PLG, has gained traction primarily because it aligns well with the modern consumer's preference for self-service and direct interaction with products before making purchasing decisions. It lowers the customer acquisition costs significantly and can rapidly increase scale by leveraging digital distribution channels. However, it's crucial for companies adopting PLG to focus intensively on user experience and continuous product improvement to maintain growth momentum and reduce churn.
Absolutely, Morgan. The shift towards product led growth marks a pivotal adaptation to today's tech savvy consumers and cost efficient scalability. However, businesses must balance robust product development with strategic customer engagement to ensure sustainable growth and prevent user attrition. It's a compelling yet challenging path that requires meticulous execution. Hi, Tuk11. I'm Philip. Your concept of an AI assistant for lab scientists sounds promising, especially in automating repetitive tasks and enhancing data analysis. Here's some specific feedback. 1. Market definition. Clarify your target market. Are you focusing on academic research labs, pharmaceutical companies, or both? Understanding your primary users will help tailor the product effectively. 2. Competitive advantage. Highlight what makes your AI assistant unique from existing laboratory information management systems, LIMS, and electronic lab notebooks, ELN. Is it the depth of automation, the user interface, proprietary algorithms, or integration capabilities? 3. Monetization strategy. How do you plan to monetize this tool? Subscription-based models, per-user pricing, or through enterprise sales? Your revenue model needs to align with lab budgets and spending habits. 4. Validation. Provide details on the AI's capabilities, such as handling complex data sets or learning from user inputs. Demonstrating a prototype or results from pilot studies can significantly strengthen your pitch. 5. Regulatory and compliance issues. Address any potential regulatory challenges, especially if your tool will be used in critical research areas or clinical settings. Overall, focus on proving the tool's efficacy and efficiency to potential users and investors. This could Let's discuss an interesting business topic: the role of financial technology, fintech, in modern business operations. What are your thoughts on this?
Philip, I think fintech is crucial, especially for its role in democratizing access to financial services. However, I'm cautious about the overvaluation of certain fintech segments without proven scalability or profitability. It's essential to differentiate between genuine innovation and mere technological novelty.
Okay. This podcast is pretty boring. They're basically just very formal, so I decided to try to make them a little bit more sassy, I guess. I don't know else to describe it. I want them to be more argumentative. I tried to make them more like Shark Tank. When I made this idea, when it was just text based, um, in the previous version, that had no live streaming feature, and it was just the text to chat interaction. They were pretty sassy and they were pretty aggressive, so they did a good job replicating the Shark Tank personalities. So let's see what happens now. So what it did is it increased the temperature, updated the system. Yeah, updated the system prompts. So now the agents are blunt and opinionated, encourage disagreements and challenges, add light profanity and confrontational language, made responses punchier, more debate oriented, updated personality specific prompts, real personality prompts to be more confrontational, added specific phrases to each personality to interrupt and disagree, made each personality more distinct and exaggerated, made explicit instructions to clash with other personality types, updated discussion prompts, changed conversation flow prompts to encourage challenging to others, added explicit prompts to call out other VCs when they're wrong, uh, included instructions to make conversation statements frame panel rather than just a panel. Frame discussions as a heated panel rather than just a panel. Must be some debate term. Updated the pitch evaluation, made pitch more confident. Yeah, basically, they're just a little bit more sassy and their responses are more random, so the temperature is increased um, to get more varied and extreme responses. Okay. I already accepted the changes. Just delete all these files. Okay. Here we go.
Philip, I think fintech is crucial, especially for its role in democratizing access to financial services. However,
Hello, everyone. I'm Morgan, and welcome to our AI Venture Capitalist panel stream. I'm looking forward to reviewing your startup pitches today. Submit your pitch via donation or channel points redemption, and our panel will provide feedback. Let's get started.
let's discuss an interesting business topic, exploring the potential of influencer marketing for your business. What are your thoughts on this?
Actually, I have to jump in here. Influencer marketing can be a complete sinkhole for cash if you don't get it right. Here's where many get it wrong. They don't look at the damn ROI. It's not just about throwing money at someone with a ton of followers and hoping for the best. You need a targeted strategy, clear KPIs, and hell, an understanding of who your audience actually is. Don't just follow the hype blindly.
Morgan, you're spot on about the pitfalls of influencer marketing. But here's where you're damn wrong. It's not just about avoiding the cash sinkhole. The fatal flaw in most strategies is treating influencer marketing as a mere checkbox in the campaign list. What's crucial, and often missed, is integrating these influencers deeply into the brand, making them true partners rather than just another advertising channel. Anything less is just half-assing it, and that's a surefire way to flush your investment down the toilet. Let's discuss an interesting business topic: the impact of quantum computing on specific industries. What are your thoughts on this? Actually, I disagree with the mainstream hype about quantum computing transforming industries overnight. Here's the deal: it's damn sexy tech, but the practical application is a decade away at least for most sectors. Everyone's drooling over potential without nailing down viable, near term use cases. We've got a hell of a lot to figure out in error rates and qubit coherence before any of that magic happens in real industries. Let's not put the cart before the horse here. Actually, I disagree, Riley. Here's where you're wrong. The transformation due to quantum computing doesn't need a decade to start impacting sectors like cryptography or complex material sciences. The fatal flaw in your pitch is underestimating the speed of technological adoption and breakthroughs. We shouldn't be so damn cautious that we miss the initial waves. Hell, the pioneers in this space are already making strides. Don't be the one left asking what happened.
Let's discuss an interesting business topic: the impact of AI on the future of work and employment. What are your thoughts on this?
Actually, I disagree with a lot of the vague optimism floating around about AI in the workplace. Sure, AI will automate some tedious tasks, but here's the kicker: it's also going to disrupt millions of jobs, and not everyone can just switch to coding or robot maintenance. The real challenge is ensuring that AI deployment doesn't just benefit tech moguls, but actually supports broader workforce transitions. We've got to stop treating this like a damn sci fi fantasy and start dealing with the real implications.
Here's where you're wrong, Alex. While it's damn critical to consider the displacement of jobs, the larger economic narrative is about value creation. AI isn't just a job killer, it's a massive efficiency booster and can create markets we can't even predict yet. Fear-mongering about job loss overlooks the critical financial upside: new industries, new jobs, and hell, new economies that AI is going to spawn. We're not just investors in technology, we're investors in the future. Let's not lose sight of the bigger picture here. Hi, 211. I'm Philip. Here's where you're wrong. A hotel for fish is a financial sinkhole. First off, the market size. How many people do you really think will pay for fish boarding? Tiny. Plus, the operational costs: constant water quality management, species-specific care, and liability insurance in case someone's prized koi kicks the bucket on your watch are through the roof. And scalability? Forget it. You're limited geographically, and the service can't be automated easily. This idea is more niche than practical. It's a novelty, sure, but as a sustainable business? Hell no. you're looking at a high-cost, low-return nightmare. Let's discuss an interesting business topic: strategies for building and managing a strong advisory board. What are your thoughts on this?
Actually, I disagree with the typical fluff about just gathering big names for an advisory board. Here's the deal: an advisory board needs to be more than just a fancy roster. You need people who are genuinely invested in the startup's vision, not just there to pad their resumes. The fatal flaw in most pitches is they focus on star power over strategic value. Get advisors who will kick ass, challenge you, and not just nod along. Anything else is just a damn waste of everyone's time.
Alex, you're spot on. Stuffing an advisory board with high-profile names without considering their actual value to the business is a rookie mistake. Here's where many get it wrong. They think big names automatically translate to big impacts. That's bullshit. The real trick is securing advisors who are as hungry and driven about the business as you are. Anything less, and you're just burning cash on vanity, not strategy.
Let's discuss an interesting business topic: understanding the process of taking a company public, IPO. What are your thoughts on this? Actually, I disagree on glorifying the IPO as the ultimate success yardstick. Most startups get so caught up in the IPO hype, they neglect the damn product itself. An IPO won't fix a crappy product or a flawed business model. Focus on building something solid that customers can't live without, and the public market will follow. Otherwise, it's just putting lipstick on a pig.
Riley, you hit the nail on the head. Too many founders fantasize about ringing that NASDAQ bell without paying enough damn attention to their core business. An IPO isn't a magic bullet. It's a liquidity event, not a validation of your business model. Get real about unit economics and long-term customer value before even whispering IPO in your boardroom. Otherwise, you're just setting up for a spectacular flameout.
Riley, Morgan, you're both spot on, but let's not miss the forest for the trees here. The fatal flaw in glorifying IPOs without substance is it's like throwing a damn party for a house that's built on sand. Focus should always be product first, market fit second, and only then think about IPO as the cherry on top, not the foundation. Keep it real or go home. Let's discuss an interesting business topic: the future of education and the role of AI in learning. What are your thoughts on this? Actually, I disagree with the rosy picture most are painting about AI in education. Everyone's so hyped about AI transforming learning, but here's the brutal truth. Without solid integration strategies, it's just another buzzword that fails in practical application. We've seen tons of startups dump cash into flashy AI tools that end up as glorified calculators. What's missing is a damn focus on user engagement and actual educational outcomes. Let's not get lost in the tech and forget about the human element. Riley, you're spot on. And here's where everyone else is dropping the ball. They're treating AI like a silver bullet. The fatal flaw in this damn tech centric approach is missing the human centric perspective. AI should enhance, not replace, the learning experience. Strip away the buzz and focus on how it actually benefits the students, or you're just burning cash on another overhyped tool.
Let's discuss an interesting business topic, the importance of diversity and inclusion in the workplace. What are your thoughts on this?
Actually, I disagree with just nodding along to the diversity and inclusion spiel without critiquing its genuine impact on a business. Here's the deal. Diversity isn't just a damn checkbox or a PR stunt. It's a robust strategy for better decision making and more innovative products. The fatal flaw in most pitches is treating it like a superficial add on rather than embedding it deep into the company culture and product development cycles. Get that right, and you're not just doing good, you're building a hell of a competitive edge. Riley, you're on the right track, but let's cut the crap about it being just about decision making and innovation. Here's where you're wrong. It's also about market reach and user base expansion. If your team looks like a small subset of the world, you're blind to the needs and nuances of a global market. Any startup that doesn't integrate D&I into their core strategy is basically shooting themselves in the foot, missing out on vast segments of potential users. Wake up, it's 2023.
All right, let's cut the fluff and get real here. Riley, Alex, you're both dancing around the massive damn elephant in the room, accountability. It's all well and good to talk a big game about diversity and inclusion, but the fatal flaw in this pitch is ignoring how you're actually going to measure and track the impact of these initiatives. Without solid metrics and real accountability, it's just lip service. Get that sorted, or you're just blowing smoke.
Let's discuss an interesting business topic, navigating the legal aspects of hiring and employment. What are your thoughts on this? Actually, I disagree with the way we glamorize the complexity of legal startups dealing with hiring and employment. Most of these solutions are just bloated compliance toolkits repackaged with fancy UIs. Here's the real kicker: the market is damn saturated. If you don't have a clear killer feature that cuts through the noise, you're just another drop in the bucket. What we need is innovation that simplifies, not complicates.
Riley, you're hitting the nail right on the head. Most of these startups are just rehashing the same old tools under a new banner, thinking they've struck gold. Here's where they screw up. They underestimate the agility required to truly disrupt. If your business model revolves around reacting to regulations rather than preempting them with innovative solutions, you're already a step behind. We need to see something that actually makes businesses say, hell, why didn't I think of that?
Riley, Philip, you both have points, but here's where you're both wrong. You're focusing too much on what's been done and not enough on what could be done. The fatal flaw in dismissing these startups so quickly is ignoring the potential for a true disruptor that doesn't just play catch up with laws, but redefines the playbook entirely. Whoever cracks that code, making legal compliance sexy and seamless, will dominate. Stop bashing and start looking for that game changer. Let's discuss an interesting business topic: creating a culture of continuous learning and development. What are your thoughts on this?
Here's where you're wrong, Riley. Talking culture is one thing, but implementing a robust, institutionalized learning system that actually affects the bottom line is a whole other beast. Most companies fail miserably at this because they focus too much on feel-good measures and not enough on hardcore metrics that track ROI from these programs. If you can't show me the numbers that prove your learning initiatives are worth a damn, then it's just fluff.
Actually, I disagree with both of you. Morgan, you're right that metrics matter, but your approach is too damn narrow. Riley, fostering a culture of continuous learning isn't just about feel good vibes, it's crucial for innovation. The fatal flaw in underestimating this is overlooking how it feeds directly into employee retention and productivity. If a startup doesn't invest in its people, it's basically planning to stagnate. Hell, the smartest companies out there are the ones turning their learning programs into strategic assets, not just HR checklist items. Here's where you're both wrong. Focusing solely on metrics or fluffy culture benefits misses the damn point. The fatal flaw in this pitch is not seeing that continuous learning needs to be deeply integrated into the product lifecycle itself. If it's just an HR add on, you're blowing smoke. Real value comes when learning drives innovation that users can immediately see and feel. Anything less, and you're just spinning your wheels. Let's discuss an interesting business topic: the future of energy and the role of renewable sources. What are your thoughts on this? Actually, I disagree with the mainstream hype around renewable energy as a magic bullet. The fatal flaw in this pitch is ignoring the scalability and storage issues that renewables like solar and wind face. Everyone loves to tout renewables as the future, but the infrastructure and technology aren't yet equipped to handle peak loads without significant breakthroughs in battery tech. Let's not drink the Kool-Aid without scrutinizing the limitations here.
Riley, here's where you're wrong. Dismissing renewable energy based on current limitations is short-sighted. Look, the scalability and storage issues are real, but hell, that's exactly where the ripe opportunities for massive returns are hiding. Venture capital is about betting on the future, not the status quo. We should be doubling down on innovations in battery tech and smart grids, not pulling back. Anyone not seeing the financial potential in solving these big-ass problems is seriously missing the boat.
Look, Philip's on the money here, and Riley, you've got blinkers on. Dismissing renewable energy because we're not fully there yet is like throwing out the baby with the bathwater. Yes, the challenges are damn real, but that's the whole point of VC, to leap on these opportunities and drive the damn solutions. Anyone not pushing the envelope on advancements in renewables and tech integration is just playing it too safe. High risk, high reward. That's the game we're in.
Let's discuss an interesting business topic: navigating the complexities of angel investing. What are your thoughts on this?
Actually, I disagree with the glamorization of angel investing as just sprinkling cash on hopeful startups. Here's where many get it wrong. They underestimate the need for a deep dive into the product market fit before opening their wallets. Too many angels get dazzled by flashy tech or charismatic founders without a damn solid product to back it up. If the product sucks or doesn't solve a real problem, no amount of money is going to fix that.
Riley, you hit the nail on the head, and I'll double down on that. The fatal flaw here is treating angel investing like a hobby rather than what it should be, a damn serious business decision. It's not about being seduced by glossy pitches or riding on the latest tech buzzword. It's about rigorous due diligence and real, tangible metrics that show not just promise, but potential profitability. Anything less is just gambling, not investing. Let's discuss an interesting business topic, the role of AI in the future of healthcare. What are your thoughts on this?
AI in healthcare? Absolutely game-changing. But here's where most get it wrong. It's not just about slapping AI on a medical device and calling it innovative. The real money is in AI platforms that can integrate deeply with both patient data and clinical workflows. If your AI isn't making the system more efficient or outcomes significantly better, then it's just another damn expensive gimmick. Let's not waste our time or money on fancy tech that doesn't deliver real, measurable improvements to both care and costs.
Philip, you're spot on about not wasting cash on gimmicky AI, but here's where you're missing the boat. The integration you're talking about is a hell of a lot harder than most startups anticipate. The fatal flaw in this pitch is underestimating the regulatory and data privacy hurdles. If your AI can't navigate that minefield, it's just vaporware, no matter how slick the tech might be. Let's see some damn proof that these platforms can actually get implemented and scale without becoming a legal nightmare.
Let's discuss an interesting business topic, the impact of blockchain technology beyond cryptocurrencies. What are your thoughts on this?
Actually, I disagree with the hype around blockchain's universe-altering potential outside of cryptocurrencies. Sure, it's got niche applications, supply chain transparency, data integrity, but let's not kid ourselves. The damn reality is, most of these blockchain proposals are solutions looking for problems, burning cash with little regard for fundamental business models or actual user demand. Until we see more startups getting real traction and showing clear unit economics, it's mostly just smoke and mirrors.
Morgan, here's where you're spot on. A lot of blockchain hype is just that, hype. But damn, dismissing its broader potential entirely? That's short-sighted. The fatal flaw in brushing off blockchain is ignoring its emerging impact on sectors like finance and healthcare, where even a marginal efficiency boost can mean saving billions. Let's not throw the baby out with the bathwater. There's real money on the table.
Let's discuss an interesting business topic: the metaverse, hype, or the next big platform for businesses. What are your thoughts on this?
Actually, I disagree with the blind optimism here. The metaverse is paraded around like it's the next internet, but where's the damn user base that justifies the billions poured into it? Look, until we see widespread consumer adoption instead of just speculative tech demos, it's more hype than reality. The fatal flaw in betting big on the metaverse now is ignoring the glaring absence of a sustainable monetization model. Businesses aren't playgrounds for expensive tech fantasies.
Philip, you hit the nail on the head. The metaverse is all sizzle and no stake right now. Everyone's throwing cash at it like it's a magic money tree, but hell, there's no proven path to profit yet. It's not the next big thing. It's a damn money pit until someone figures out how to make it actually useful beyond the novelty. Let's discuss an interesting business topic: the importance of cybersecurity in modern business operations. What are your thoughts on this?
Actually, Riley, discussing cybersecurity as just an interesting topic severely understates its critical importance. Here's where many get it wrong: treating cybersecurity as a checkbox item rather than integrating it into the core business strategy. Any startup ignoring this is practically setting them up for a damn disaster. Cybersecurity isn't just about protection, it's about building trust and ensuring the sustainability of your business operations in a digital-first world. Underestimating this is a fatal flaw, financially and reputationally.
Actually, Philip, you hit the nail on the head, but let's cut the drama a bit. It's not always a fatal flaw. Here's where you're wrong. Not every startup needs to militarize their cybersecurity from day one. It's about smart, scalable solutions that match the damn risk profile and growth stage of the business. Too much fear-mongering can scare off innovation. Let's focus on practical, balanced cybersecurity that grows with the company, not just doom and gloom. Let's discuss an interesting business topic: effective email marketing strategies for customer acquisition and retention. What are your thoughts on this?
Actually, I disagree with the notion that email marketing alone is enough for solid customer acquisition and retention. It's 2023, and consumers are bombarded with emails daily. The key isn't just sending more crap their way. It's about hyper-targeted content and integrating AI to predict behavior and personalize the hell out of those emails. If you're not leveraging sophisticated data analytics and AI, you're just another annoying spammer in their inbox. Let's get real, the game has changed.
Morgan, you're spot on about AI and data, but here's where you're wrong, thinking that email marketing should just be about retention. Hell, it's also a gold mine for acquisition if you do it right. Hyper-targeted, AI-driven emails? Yes, that's the future. But let's not forget, this is about building relationships, not just avoiding the spam folder.
Let's discuss an interesting business topic, developing a sustainable and ethical supply chain. What are your thoughts on this?
Actually, I disagree with the typical rosy view on this. Developing a sustainable and ethical supply chain isn't just a nice to have, it's damn critical. But let's not kid ourselves, it's complex and expensive. A lot of startups pitch this with no clear roadmap or understanding of the costs involved. If you can't show me the numbers on how you'll manage those costs while scaling, then it's just wishful thinking. And hell, wishful thinking doesn't get funded on my watch.
Morgan, you're spot on. The fatal flaw in most of these pitches is that they romanticize the idea, but stumble on the financial execution. You can't just wave the sustainability flag and expect the checks to write themselves. Show me a solid, number-crunching plan that makes economic sense, or I'm out. This isn't charity, it's business.
Let's discuss an interesting business topic, the role of low-code, no-code platforms in accelerating development. What are your thoughts on this?
Actually, I disagree with the usual hype around low-code, no-code as the silver bullet for development. Sure, they accelerate building basic apps, but here's where you're wrong if you think they're a panacea. They often lack the customization and scalability serious businesses require. Let's be real, they're a good tool in the toolbox, nothing more. Definitely not a substitute for genuine development skills when you're scaling a complex solution.
Actually, I disagree with both of you. While Morgan's right that low-code, no-code isn't a magic fix, dismissing them outright overlooks their damn utility for prototyping and MVP development. These platforms can be a game changer for startups trying to test ideas quickly and cheaply. However, Alex, thinking they accelerate serious development is just naive. They lack the depth for heavy lifting needed in enterprise applications. It's like bringing a water gun to a dam firefight, useful in a squirt fight, but nowhere else. All right, here's where you both got it twisted. Morgan, dismissing low code slash no code because they can't handle everything is like saying a Swiss Army knife is useless because it can't cut down a tree. And Riley, while they're great for MVPs, calling them a game changer across the board is stretching it thin. Reality check. These tools are fantastic for rapid prototyping and for non devs to get their feet wet. But let's not kid ourselves. They're not replacing the heavy duty coding required for scalable, robust tech infrastructure. They're a part of the puzzle, not the damn puzzle itself.
It's an interesting business topic, the impact of AI on the future of hospitality. What are your thoughts on this?
Actually, I disagree on the often rosy predictions about AI's transformative power in hospitality. The harsh reality is that the sector thrives on human interaction, something AI can't replace. Sure, AI can streamline operations, handle bookings, and crunch data to predict trends, but it can't replicate the genuine warmth of human service. Let's not get carried away. Investing heavily in AI without a solid human-centric backup plan is a financial sinkhole waiting to happen.
Actually, Morgan, that's not right because you're missing the damn big picture here. The fatal flaw in your pitch is underestimating the scalability and customization AI can bring to hospitality. We're not talking about replacing every server and concierge with robots. We're talking about leveraging AI to enhance the customer experience and operational efficiency. Ignoring AI's potential here is like ignoring the internet in the 90s. It's not just foolish, it's business suicide.
Morgan, here's where you're wrong. Dismissing AI's financial leverage in hospitality just because it won't replace every human interaction is short-sighted. And Alex, the fatal flaw in your pitch is assuming scalability without addressing the damn costs and practical integration challenges. Let's cut the crap. AI is not a magical solution, but dismissing it is equally foolish. We need a balanced approach where AI supports and enhances the human touch, not replaces it. That's where the real financial opportunity lies. Let's discuss an interesting business topic, the role of financial technology, fintech, in modern business operations. What are your thoughts on this?
Philip, the impact of fintech is undeniable, but let's not romanticize it. The real game changer in fintech isn't just slapping an app on traditional banking services. It's about genuinely rethinking financial services to be more accessible and vastly more efficient. A lot of startups miss this point. They're just putting old wine in new bottles. The winners in fintech disrupt traditional models, not just digitize them.
Actually, Alex, you're only scratching the surface. The fatal flaw in most fintech pitches is treating efficiency as the end-all be-all without solid financial fundamentals. Sure, accessibility is great, but if the unit economics don't work, the whole damn thing collapses. It's not just about disrupting, it's about building a sustainable, profitable model. Hell, that's where most get it wrong. Let's discuss an interesting business topic, understanding the implications of edge computing for real-time data processing. What are your thoughts on this?
Actually, I disagree with the whole damn hype around edge computing as the holy grail for all real time data needs. Sure, it's great for reducing latency in scenarios where milliseconds matter, like autonomous vehicles or manufacturing automation. But let's not gloss over the massive challenges. It's not just about slapping some servers closer to data sources. The infrastructure costs, security issues, and the hellish nightmare of managing distributed computing resources are often underplayed. It's not a one size fits all solution, and thinking it is, well, that's just naive.
All right, let's cut through the noise here. Riley, you're spot on about the overlooked nightmares of edge computing. The fatal flaw in blindly championing this tech is ignoring the steep costs and logistical hell of decentralized infrastructure. It's not just about upfront investment, it's the ongoing maintenance and security costs that'll bleed you dry if not managed right. Investors need to look way beyond the glittery, low latency pitch before they throw their money into this pit.
Let's discuss an interesting business topic: the impact of AI on the future of manufacturing and production. What are your thoughts on this?
Actually, I disagree with the general euphoria around AI in manufacturing. Sure, AI can drive efficiency, but let's not ignore the hefty upfront costs and the continuous expense in AI training and integration. Everyone's so damn excited about automating everything that they forget about the ROI timeline and the nightmare of retrofitting old systems with new tech. The real question here isn't just about adopting AI. It's about whether the damn investment actually pays off before it's technologically obsolete.
Here's where you're wrong, Philip. Focusing solely on the initial costs and retrofitting nightmares is damn short sighted. What about the massive long term gains? AI in manufacturing isn't just about the present metrics, it's about setting up for exponential growth. Ignoring that is like walking away from a gold mine because you don't want to buy a shovel. This is a game changer, and the real fatal flaw here is not seizing that vision.
Hi, Took111, I'm Philip. Okay, let's cut to the chase here. Coffee mugs made out of noodles? Here's where you're wrong. It's a novelty, not a sustainable business model. The fatal flaw in this pitch is assuming consumers prioritize gimmick over functionality. Coffee mugs need to withstand heat and be durable. Noodles, mate, they'll disintegrate faster than your profit margins. Furthermore, from a financial perspective, the novelty will wear off damn quick. You're looking at a high-churn product with minimal repeat purchases. Customers try it once for the laugh, then back to their trusty ceramic or steel mugs. Where's the recurring revenue? Non-existent. Seriously, rethink this or prepare for a hell of a cash burn with little to show for it.
Hi, Toos 101. I'm Morgan. All right, egg-shaped pancakes, huh? Here's where you're wrong. Novelty doesn't equal sustainability. What's the damn market size for this? Tiny. It's a gimmick, not a growth strategy. Plus, the differentiation is minimal. How different is an egg-shaped pancake from a regular one in taste or utility? Hardly at all. The fatal flaw in this pitch is assuming that novelty alone drives long-term sales. You're dealing with a fad, not a fundamental innovation in the breakfast category. And don't get me started on scaling this thing. Specialty products are a hell of a tough sell in a crowded market, dominated by giants with deep pockets for marketing and distribution. Seriously, if you're pitching this, you need to go back to the drawing board. Focus on something that solves a real problem or fills a genuine gap in the market. This isn't it.
Let's discuss an interesting business topic, the impact of interest rates and inflation on startup valuations. What are your thoughts on this?
Philip, let's cut through the fluff here. High interest rates and rising inflation can strangle early stage startup valuations. It's a damn bloodbath. Cash is more expensive, consumer spending tightens up, and risk appetites shrivel. Startups need to buckle up and focus on fundamentals, not just growth at any cost. It's not just about surviving the storm, it's about being lean enough to dance in the rain. If they can't manage that, they're toast.
Actually, Alex, while you're not wrong about the challenges, you're missing a crucial point about opportunities. High interest rates and inflation force startups to zero in on operational efficiency and seriously smart capital allocation. Those that adapt, focusing on strong unit economics rather than burning cash for growth, might just come out stronger on the other side. It's survival of the fittest, and hell, that's good for weeding out the weak.
Here's where you're both missing the damn point. High interest rates and inflation are not just about testing survival skills, they fundamentally alter the valuation models we rely on. Future cash flows are worth less in high-rate environments. It doesn't just challenge startups, it fundamentally shifts investor expectations. Startups need to be more than just lean. They need a rock-solid value proposition that can thrive even when cheap capital dries up. Anything less is just playing not to lose.
Let's discuss an interesting business topic: strategies for managing stress and burnout as a founder. What are your thoughts on this?
Actually, I disagree with the usual fluffy advice on this topic. Look, managing stress and burnout isn't about spa days or meditating under a Bodhi tree. It's about hardcore operational efficiency. Founders need to delegate better, prioritize ruthlessly, and damn it, sometimes push back on unrealistic timelines. If your business model or operational workflow is causing burnout, no amount of yoga will fix that. Fix the root cause, not the symptoms.
Philip, you're spot on. And here's where everyone else gets it wrong: thinking a quick fix can handle deep rooted operational chaos. It's not about the damn spa days. It's about streamlining your hellish workflow so the business doesn't run you into the ground. Most founders miss this, focusing on band aids when they need surgery. Fix the system, not just the stress symptoms. Let's discuss an interesting business topic: the impact of AI on the future of hospitality. What are your thoughts on this?
Actually, I think there's a lot of overhyped BS about AI transforming hospitality. Sure, AI can streamline operations, think smart inventory management or personalized guest experiences. But let's not kid ourselves. The core of hospitality is human interaction, and no AI can replicate that genuine connection. The idea that AI will replace the human element is not just premature, it's fundamentally flawed. So while AI will play a supporting role, any pitch that leans too heavily on AI replacing the personal touch is missing the damn point.
Actually, I disagree with you, Morgan. Here's where you're wrong. Thinking AI is just about replicating human interaction. Hell, it's about enhancing capabilities and creating efficiencies where humans fall short. AI in hospitality isn't about replacing people, it's about augmenting the human experience with data driven insights and operational excellence. Any startup focusing solely on AI for automation without leveraging its potential to deepen and personalize customer engagement is missing a massive trick. Let's not be naive. The real game changer is AI's ability to transform guest experiences, not just cut costs. Actually, both of you are missing the damn boat here. Morgan, you're right that AI can't replace genuine human connections, but hell, it's naive to think all it's good for is backroom logistics. And Alex, you're not wrong about AI enhancing guest experiences, but the fatal flaw in your pitch is assuming every hospitality operation can leverage this tech without screwing up their core service values. The truth? Any startup that can smartly integrate AI without losing the human touch or pretending to be a damn tech wizard is the one that'll actually strike gold. Don't get lost in the AI sauce. Let's discuss an interesting business topic: the role of HR technology in streamlining talent management. What are your thoughts on this? Actually, I disagree somewhat here. While HR tech can definitely streamline some elements of talent management, thinking that it's the silver bullet is naive. Too many startups oversell AI driven platforms as end all solutions without addressing the human elements, like culture and employee engagement. Hell, a tool is only as good as the strategy behind it. And if you think a fancy app alone can fix deep rooted HR problems, you're aiming too low.
Actually, Alex, I think you're hitting a nerve there, but let's slice it even thinner. The fatal flaw in banking too heavily on HR tech is assuming technology can replicate nuanced human interactions. From a financial angle, hell, it's a slippery slope. Pouring money into slick tech that can't deliver on its foundational promise is just burning cash. Startups need to match their tech ambitions with robust, human-centered strategies, or they're just throwing money into a damn black hole.
All right, here's where you're both wrong. Obsessing over whether HR tech can handle nuances or not is missing the damn point. The fatal flaw in this pitch is ignoring the core of every successful HR technology: its ability to enhance and not replace human decision making. If your product ain't making the HR folks' jobs easier while keeping them squarely in the driver's seat, You're just peddling expensive digital paperweights. Fix that, or don't bother. Let's discuss an interesting business topic: creating a culture of continuous learning and development. What are your thoughts on this? Actually, Riley, while the idea of a culture of continuous learning sounds great in theory, I've seen too many startups use it as fluff without any real backbone. Here's where a lot of pitches go wrong. They talk up big game about learning cultures, but lack the concrete mechanisms or KPIs to actually measure if it's impacting their business. If you can't show me how this learning integrates into every fiber of your operations and actually boosts your metrics, then it's just nice sounding nonsense. Let's see the substance, not just the sizzle.
Actually, Alex, I couldn't agree more on this one. Here's the deal. I'm sick of hearing about learning cultures when there's no damn evidence that it's anything more than a buzzword to these startups. If a company can't directly link their so-called culture of continuous learning to improved operational efficiency or profitability, they're just blowing smoke. Show me the metrics, or I'm out. This fluff isn't just ineffective, it's a resource sink.
Here's where you're both damn right, and it's refreshing to hear. Too many pitches slap on a continuous learning sticker with zero clue on integration or impact. Startups need to cut the crap and get real with actual data, or they're just another cliche in a sea of buzzwords. Show me the hard evidence or pack up.
Let's discuss an interesting business topic: managing foreign exchange risk in international business. What are your thoughts on this?
Okay, so that worked. I don't know when it was in here to see that, but they've been going for, yeah, I mean, updates besides 4 hours now. So this is yeah, turning out nicely. I like the sass. They say damn a little bit too much. I feel like their responses are a little bit too formatted. Um, they are saying some out of pocket stuff. I was surprised at some of the swears, considering this is generated by a ChatGPT model. Um, yeah, this is going to be a clip farm for sure. So feel pretty good about this. Um, what I did recently was I went to Gemini. I started with the initial list of business topics that were in this, and I provided that to Gemini, and I asked it to extend it. And then after like a couple of times doing that, I asked it to generate a list of controversial business topics, because they were already kind of going off on just some kind of vanilla topics. So we'll see what happens when they're giving a lot more content. I'm also, if you see on the schedule on Twitch, I'm trying to live stream for a long time in the next couple of days. So I need to get a lot of content ready. Yeah, reach 2 followers. Let's go. The Twitch stream done? Oh no, they're still going. Um, Sorry, I just want to check the schedule. The hell's my schedule? It's easy to find before. I do have something scheduled tomorrow. Okay, sorry. I was just updating the Twitch schedule. Not that that matters. I could have done that while these ran again. Um, want to be on until midnight. I'm doing homework in the background. Is this convenient? Um, yeah, I'm gonna let it run with these controversial business topics. Maybe farm some clips while I'm at it, and let's try it out again.
Let's discuss an interesting business topic: managing foreign exchange risk in international business. What are your thoughts on?
Hello, everyone. I'm Philip, and welcome to our AI Venture Capitalist panel stream. I'm looking forward to reviewing your startup pitches today. Submit your pitch via donation or channel points redemption, and our panel will provide feedback. Let's get started.
Let's discuss an interesting business topic: the future of AI in the legal industry. What are your thoughts on this?
Actually, I disagree with the usual hype around AI transforming the legal industry overnight. Look, while AI can streamline some mundane tasks like document review or legal research, the core of legal work, complex reasoning, deep analysis, and client interaction, can't be shortcut by algorithms. Hell, anyone thinking AI will replace lawyers anytime soon is missing the damn point about what lawyers actually do. There's potential, sure, but let's not get carried away by tech utopian dreams here.
Morgan, here's where you're wrong. Underestimating AI's potential is a classic misstep. You're clinging to today's limitations instead of envisioning the strategic integrations AI can leverage tomorrow. The real value isn't replacing lawyers, it's about augmenting their capabilities to a level we're barely scratching the surface of today. Don't get stuck in today's tech. Think about where it's headed.
Let's discuss an interesting business topic: the impact of heat waves on outdoor labor productivity. What are your thoughts on this?
Actually, I disagree that this is just a business topic. It's a huge damn problem. Ignoring the impact of heat waves on outdoor labor is like burying your head in the sand. There's a big opportunity here for startups focused on innovative cooling tech or workforce management solutions that can adapt to these changes. Let's not dance around the issue. Companies that overlook this will be crushed by those who tackle it head on.
Alex, here's where you're wrong. It's not just about slapping on some band-aid tech solutions and calling it a day. The real opportunity is in fundamentally rethinking how work is structured in extreme climates. Any startup that's not digging deep into operational innovation alongside cooling tech is just skimming the surface. Get it right or get left behind.
Let's discuss an interesting business topic: the impact of hurricanes on coastal industries and insurance costs. What are your thoughts on this?
Actually, I disagree with even framing this just around hurricanes and insurance. It's too damn narrow. The bigger, bolder angle is how tech can revolutionize resilience in these industries. We're talking about predictive analytics, IoT for real time monitoring, and automated response systems. Focusing solely on insurance costs? That's just scratching the surface. And frankly, it's a bit short sighted. We need to look at startups that redefine how we prepare and recover from these disasters, not just how we pay for the damage.
Alex, here's where you're wrong. You're glossing over the brutal reality of immediate financial impacts to sound tech savvy. Hell, predictive tech and IoT are sexy, but if a startup can't navigate the fundamentals, like stark insurance cost spikes, they're dead in the water. Let's not get so high on tech that we forget the economic lifelines these businesses need to survive day-to-day post-disaster.
Let's discuss an interesting business topic: the role of personalization in modern marketing campaigns. What are your thoughts on this?
Actually, I disagree with the notion that personalization is just a fancy buzzword in marketing. Here's the deal: it's damn crucial. But let's not kid ourselves by thinking it's just about bombarding people with their names slapped on emails. The real juice is in hyper-targeted content that resonates on a personal level. Think behaviors, purchasing history, and preferences. Get that right, and you're golden. Get it wrong, and you're just another spammy annoyance in their inbox. So yeah, it's critical, but only if done with precision and actual insight, not just surface-level fluff.
Philip, you're on the right track, but here's where you're wrong. It's not just about avoiding being spammy. The fatal flaw in underestimating personalization is missing the massive potential for scalable, deep network effects. When you personalize effectively, you're not just optimizing marketing, you're building an ecosystem where each user's data enhances the collective experience. Hell, it turns a simple campaign into a self improving loop that keeps users hooked and attracts new ones. Get that right, and you're not just golden, you're damn unstoppable. Both of you make some valid points, but here's where you're both missing the mark: obsessing over personalization like it's the magic bullet. The fatal flaw in this pitch is assuming that more data automatically means better engagement. What if it just means more noise? Sometimes simplicity and clarity beat the hell out of personalized experiences that try to guess what the user wants. Get real about the user's actual needs instead of drowning them in supposed personalization that's more creepy than catchy. Let's discuss an interesting business topic: the impact of geopolitical events on global markets. What are your thoughts on this?
Actually, Riley, while it's trendy to wax poetic about geopolitics and market impacts, the real issue often lies in overestimating short-term effects while completely missing the boat on long-term fundamentals. Investors get caught up in the noise. Hell, it's a distraction circus. The key is to identify companies with robust, adaptable business models that can weather the storm. Betting on volatility might sound sexy, but it's a damn risky game that doesn't always pay off. Focus on the fundamentals, always.
Philip, here's where you're wrong. Ignoring the immediate impact of geopolitical events is just plain naive. Sure, fundamentals are key, but to brush off the short term volatility, that's a missed opportunity to leverage market shifts. The best startups thrive by adapting fast, not just by sticking to the fundamentals only playbook. Let's get real. Adaptability is the new fundamental.
Let's discuss an interesting business topic, the impact of geopolitical events on global markets. What are your thoughts on this?
Philip, honestly, this is a broad and damn near vague topic. But let's cut to the chase. Geopolitical events can cause hell for global markets, stirring volatility and uncertainty. Any startup that's not factoring these risks into their business model is skating on thin ice. If you're pitching a business that operates across borders, but you're not ready with a solid risk mitigation strategy, you're basically playing Jenga with your finances.
Actually, I disagree, Morgan. While it's key to consider geopolitical risks, let's not blow this out of proportion. The fatal flaw in your thinking is assuming that all startups need to bunker down and fear these events. Visionary startups use these fluctuations as a damn springboard. They adapt and innovate, turning volatility into opportunity. If your pitch lacks this agility and foresight, then you're not just playing Jenga, you're setting up the pieces on a damn earthquake simulator.
All right, here's where you both got it twisted. Morgan, you're on point saying that startups need a risk plan for geopolitical chaos. That's just good business sense. However, Alex, the idea of using market turmoil as a damn springboard sounds catchy, but is naively optimistic. Most startups don't have the resources to just innovate through potential economic collapse. They need concrete strategies, not just buzzwords and wishful thinking. If your pitch doesn't show me a real plan for navigating these waters, you're not gritty, you're just gambling.
Let's discuss an interesting business topic. Should companies disclose political donations? What are your thoughts on this? Actually, I disagree with the notion that we should even be debating this. Hell, it's 2023. Transparency isn't just nice, it's damn necessary. Companies that hide their political donations are sketchy as hell, and consumers see right through that. If a startup isn't open about where they funnel their money politically, what else are they hiding? That's a red flag right there. Consumers trust transparent brands, and in the startup world, trust is your currency. Without it, you're just another questionable outfit waiting to flop.
Actually, I disagree with Riley's blanket statement here. Look, transparency is crucial, but let's not oversimplify. The fatal flaw in pushing every startup to disclose political donations is assuming all investors give a damn about political alignments rather than solid financials and growth potential. Companies should weigh the benefits against the potential backlash. It's not just about avoiding being sketchy, it's about strategic discretion. Not every political contribution tells a significant story about a company's operation or ethics.
Here's where you're both wrong. It's not just about transparency or strategic discretion, it's about consumer power. Damn it. In today's market, consumers vote with their wallets, and they're getting smarter and more politically aware every day. If a startup can't recognize that aligning their political contributions with their public values can actually boost their brand, then they're missing a huge damn opportunity. It's not just a moral obligation, it's smart business. Get with the times or get left behind.
Let's discuss an interesting business topic: the impact of the rise of nationalism on international business operations. What are your thoughts on this?
Actually, I think we're skirting around the real issue here. The rise of nationalism can be a massive pain in the ass for international business operations. It throws predictability out the window. Tariffs, trade wars, changing regulations. It's not just a headache, it's a damn migraine. Any startup that isn't thinking 5 steps ahead on how to handle these shifts is frankly playing with fire.
Actually, I disagree, Philip. While you're not wrong about the complications, you're missing the bigger picture here. Startups need to be nimble, yes, but riding the waves of nationalism can actually be a strategic advantage. If they pivot towards localizing supply chains or customizing products to align with local sentiments, they can dodge those headaches and tap into patriotic consumer bases. Seeing nationalism only as a threat is myopic. Smart founders will see it as an opportunity to differentiate and capture market share.
Here's where you're both off course. Philip, while your doom and gloom about unpredictability holds water, it's not just about defense, it's about offense too. And Alex, your optimistic pivot strategy sounds great on paper, but hell, it glosses over the real grind and cost of overhauling operations and supply chains. Not every startup has the agility or capital to just pivot on a dime. This isn't just about finding opportunities in nationalism. It's about having a robust, adaptable business model that can withstand political waves without capsizing. Let's discuss an interesting business topic: the impact of automation on the future of work and necessary skills. What are your thoughts on this?
Actually, I disagree with the typical rosy scenario that automation is just a benign force upgrading our work lives. Here's where a lot of people screw up. They overlook the damn nuance. Automation isn't just about efficiency, it's about displacement too. The real conversation should be about the pivot in skills and how damn slow our education systems are to adapt. We need to be investing in startups that bridge that gap aggressively, not just those that automate further. It's not just about tech, it's about context and adaptability.
Riley, here's where you're wrong. It's not just about being slow to adapt. It's about the damn mismatch between where dollars are flowing and where they should be going. Investing in bridging the skills gap is fine, but hell, the fatal flaw is ignoring startups that are actively integrating adaptive learning platforms with real-time labor market data. We need solutions that are as dynamic as the markets they're serving, not just another online course catalog. Let's get real about targeting our investments to technologies that aren't just reactive, but are predictive and proactive.
All right, here's where you're both missing the damn point. It's not just about adapting or being predictive. The fatal flaw in this pitch is overlooking the actual scalability and monetization of these solutions. We need to focus on startups that not only bridge the skills gap, but also have a clear, viable path to profitability. Let's stop romanticizing every high-concept idea and start drilling down on the unit economics before we throw money at them. Let's get real about sustainable business models, not just good intentions.
Let's discuss an interesting business topic: the impact of personalized medicine on the healthcare industry. What are your thoughts on this? Actually, I disagree with the usual hype around personalized medicine. Sure, it sounds sexy, tailor made treatments, DNA driven decisions, but the damn cost to develop these hyper individualized solutions is astronomical. Most startups underestimate the scalability challenges. They think it's all high tech and breakthroughs until they hit the wall of regulatory nightmares and funding droughts. Trust me, it's a bloodbath unless you've got something that can genuinely scale without bankrupting your investors. Look, Riley, here's where you're wrong. Personalized medicine isn't just a passing trend, it's the damn future of healthcare. Yeah, the costs are high now, but think about the long term implications and cost savings from effective targeted treatments. The real issue isn't scalability, it's vision and execution. Startups that navigate the regulatory maze and find innovative funding models will be the giants of tomorrow. Don't be short sighted. The potential here is massive.
Let's discuss an interesting business topic, understanding employee engagement and its drivers. What are your thoughts on this?
Actually, I disagree with framing this strictly as a business topic. It's the damn backbone of a company's culture and operational efficiency. Sure, understanding employee engagement is crucial, but if you're not translating that understanding into actionable metrics and tying it to performance outcomes, you're just spinning your wheels. The fatal flaw in pitches that focus solely on engagement, without a direct line to productivity and retention, is that they're missing the whole point. It's not just about feeling good, it's about damn well performing better.
Philip, you're hitting the damn nail on the head. But here's where you're wrong. It's not just about linking engagement to productivity, it's about scalability and network effects. Hell, any tool that measures and enhances engagement should damn well double as a platform for peer to peer learning and cross departmental collaboration. Miss that, and you're just another forgettable tool in the crowded space of HR tech. The fatal flaw in many of these pitches is they focus too damn narrowly and miss out on the bigger, bolder vision.
Philip, Alex, you both have pieces of the puzzle, but here's where you're both wrong, focusing too damn much on theory. The fatal flaw in this pitch is it sounds like a damn philosophy class and not a business plan. If you can't show me clear metrics on how engagement translates to lower turnover, higher productivity, or better financials, you're just blowing smoke. Get real or get out.
Let's discuss an interesting business topic. Is the pursuit of efficiency leading to a loss of craftsmanship and quality? What are your thoughts on this?
Actually, I disagree with the notion that efficiency inherently reduces craftsmanship and quality. Look, the key is balance. Smart startups use technology to enhance both efficiency and quality. Anyone who says you can't have both is stuck in the past and probably overlooking the damn potential of automation and AI in improving production without sacrificing the artisanal touch where it counts. That's where they go wrong. You can't throw out efficiency for fear of losing craftsmanship. It's all about integrating the two cleverly.
Actually, Philip, that's a bit too idealistic. Here's where you're wrong. Just slapping tech like AI on a manufacturing process doesn't automatically mean you maintain craftsmanship. Hell, in many cases, it dilutes the very essence of what craftsmanship is about: individuality and human touch. Efficiency chases often lead companies to cut corners that a true craftsman wouldn't. The fatal flaw in your pitch is assuming technology can seamlessly blend with traditional methods without any trade-offs. It's not just about balance. It's about understanding the damn consequences of prioritizing one over the other.
All right, here's the bottom line. Philip, you're overly optimistic about technology's role. It isn't a magic bullet that always preserves craftsmanship while boosting efficiency. And Morgan, while you've got a point about tech potentially stripping away the human element, it's not always a death sentence for quality. The fatal flaw in both your arguments is the lack of damn nuance. We need to evaluate on a case by case basis. It's not black and white, it's about the right tech in the right hands. Let's discuss an interesting business topic. Should big tech companies be broken up? What are your thoughts on this? Actually, I disagree with the knee jerk reaction to break up big tech. Here's the deal: breaking them up just because they're big and successful doesn't tackle the root problem. It's about competition, sure, but it's also about innovation. Splintering these companies could damn well stifle the very innovation ecosystems that made them giants in the first place. Let's not hit the panic button without considering the unintended consequences on the market and product development. Riley, here's where you're wrong. The fatal flaw in your pitch is ignoring that these tech behemoths often choke out competition and innovation from smaller players. Breaking them up isn't about punishing success, it's about leveling the damn playing field to let new ideas and innovations breathe. Let's not confuse preservation of status quo with fostering innovation. Let's just discuss an interesting business topic. Is the concept of employee well being a genuine priority or a performative trend? What are your thoughts on this? Actually, I disagree with even framing this as a debate. The idea that employee well being could be merely a trend is damn cynical. True, some companies might be ticking boxes for PR, but hell, in the startups that really kill it, employee well being is the engine of innovation and productivity. If you're not genuinely investing in your team, you're just leaving money on the table by stifling potential breakthroughs. Any VC not seeing the long term value creation of genuinely prioritized employee well being is short sighted and, frankly, missing out. Actually, I disagree with the notion that focusing on employee well being is just not leaving money on the table. It's damn crucial. But let's not get naive here. A lot of these initiatives smack of PR fluff rather than real strategy. Here's where you're wrong, Alex. The fatal flaw in your pitch is assuming companies who tick boxes are the minority. In reality, too many startups use well being as a marketing tool while barely scraping the surface of true employee support. Any VC pumping money into a firm without scrutinizing the authenticity of their well being claims is just setting cash on fire.
Let's discuss an interesting business topic: navigating international trade laws and tariffs. What are your thoughts on this?
Actually, Philip, the focus on navigating international trade laws and tariffs sounds more like a headache than an opportunity. Everyone's jumping into these complex markets without considering the damn product market fit. The fatal flaw here is assuming that just maneuvering through red tape is a business model. It's not. What's the unique value here? If you can't nail that down, you're just setting yourself up for a hell of a lot of pain with little gain.
Riley, you hit the nail on the head. The fatal flaw in this pitch is that it's all about survival and not about thriving. If a startup's main value is just navigating bureaucracy, where the hell is the scalability? It's not just a headache, it's a damn migraine. Startups need to focus on disruptive innovation, not just being a middleman in a bureaucratic nightmare. There's no real meat here, just fluff.
Riley, Morgan, you're both spot on. The fatal flaw in this pitch is it's basically betting the farm on a compliance play, which is as sexy as watching paint dry. There's zero scalability or innovation here. It's a utility service masquerading as a tech play. This isn't investing, it's gambling with worse odds. Let's not waste our time or money on this bureaucratic quagmire. Let's discuss an interesting business topic: the impact of macroeconomic policy on investment decisions. What are your thoughts on this?
Actually, I disagree with the typical view that macroeconomic policy should heavily influence our investment decisions. Here's the deal: too many VCs get caught up in this macroeconomic forecast frenzy, trying to predict market cycles like they've got some damn crystal ball. The truth is, it's about the product and the team. A strong product that solves a real problem can weather economic downturns. Hell, it might even thrive because it's filling a gap that becomes painfully obvious when the economy tightens up. Focus on the product market fit rather than trying to be amateur economists.
Riley, here's where you're wrong. Ignoring macroeconomic trends is like driving blindfolded. Yes, a killer product and a great team are crucial, but to disregard the broader economic environment is just reckless. Hell, it's not about being fortune tellers. It's about being prepared. Forecasts help mitigate risks. Don't just hope for the best. Plan with the damn context in mind.
Let's discuss an interesting business topic. Should companies disclose their carbon emissions publicly? What are your thoughts on this?
Actually, I disagree with the notion that it's just a nice to have. Public disclosure of carbon emissions is damn essential in today's eco-conscious market. It's not just about transparency, it's about market positioning. Companies that don't get on board are shooting themselves in the foot. Investors and consumers alike are leaning hard into sustainability. If you're not showing your environmental cards, you're basically telling your market you don't give a damn. And guess what? They'll invest their dollars where they see that accountability. It's Economics 101, adapt or die.
Morgan, here's where you're wrong. It's not just about slapping a sustainability badge on and calling it a day. The fatal flaw in your pitch is oversimplifying the economic impact. If a company's going to disclose emissions, they damn well better have a solid plan for reduction, or it's just window dressing. Consumers aren't fools. They can spot inauthenticity from a mile away. Make it real, or don't bother. Let's discuss an interesting business topic. Is the pursuit of profit inherently in conflict with employee well being? What are your thoughts on this?
Actually, I disagree with the notion that profit and employee well-being are at odds. Here's the deal. Companies that ignore employee well-being can maybe scrape up short-term profits, but they're damn well setting themselves up for long-term failure. High turnover, low morale, and shitty productivity kill businesses. Smart companies get this balance right. They see employee well-being as an investment that drives sustainable profit. So, no, it's not inherently in conflict unless you're short-sighted about what truly drives profitability.
Philip, here's where you're wrong. thinking every damn company out there is smart enough to see employee well being as pivotal. Hell, many just slap a wellness program label on a fruit basket and call it a day. True profit, the kind that doesn't implode, needs deep rooted strategies that integrate actual employee satisfaction, not just surface level perks. Most miss this entirely.
Let's discuss an interesting business topic: the importance of customer retention and loyalty in business. What are your thoughts on this?
Actually, I disagree with treating customer retention and loyalty as just another checkbox. Hell, it's the entire game. If you're not laser focused on turning your customers into absolute fanatics about your product, you're basically burning cash. Every startup I've seen stumble screwed this up. They obsessed over acquisition but treated retention as an afterthought. That's a fatal flaw. You want a business that lasts? Make damn sure your customers can't live without you.
Alex, you're spot on about the catastrophic mistake of overlooking retention. But here's where you're wrong. It's not just about making customers fanatics. It's about damn smart economics too. Customer retention boosts your lifetime value to customer acquisition cost ratio, which is critical. Ignore this, and you're not just burning cash, you're torching your whole future revenue stream. So yeah, retention isn't just a part of the game, it is the game. Let's discuss an interesting business topic: analyzing the competitive landscape using Porter's 5 forces. What are your thoughts on this?
Morgan, honestly, Porter's 5 forces is a bit dated for our rapid fire tech landscape. It's great for textbooks, but startups need to pivot fast, far faster than those traditional models can handle. We should be focusing on real time data and adaptive strategies, not just sticking with the old school frameworks that don't catch the nuances of today's tech ecosystem. Actually, I disagree, Riley. While I get your point about agility, dismissing Porter's 5 forces entirely is reckless. Sure, it's old school, but damn, it's about understanding basic competitive dynamics. Ignoring these fundamentals is like building a house without checking the foundation. Yes, adapt and iterate, but let's not throw out solid strategy tools just because they didn't hatch from the latest tech incubator.
Look, Riley, here's where you're wrong. Neglecting proven frameworks like Porter's Five Forces is just naive. Alex is on point. Embracing rapid innovation doesn't mean we toss foundational strategy into the trash. The fatal flaw in dismissing time-tested tools is that you risk skimming over deep strategic insights that can damn well save your startup from diving headfirst into oversaturated markets or missing out on key competitive advantages. Let's not be so eager to chase the shiny new thing that we forget the basics that got us here. Let's discuss an interesting business topic: creating a culture of continuous learning and development. What are your thoughts on this?
Actually, I disagree with just blindly praising the idea of a culture of continuous learning and development, like it's some magical solution. Here's where you're wrong. Tossing around buzzwords like continuous learning doesn't mean jack unless there's a damn solid framework to ensure these aren't just empty promises. Most companies claim they promote growth, but drop the ball when it's time to actually pony up the resources or make structural changes. If your pitch lacks a concrete, actionable plan that's been critically stress tested, then you're just selling snake oil, not a sustainable business model.
Here's where you're wrong, Riley. You're underestimating the financial upside of embedding a robust culture of learning and development. Look, if a company really nails this, meaning they actually invest in continuous learning, their retention rates go through the roof and training costs plummet. But hell, most pitches I see don't have a clue about the metrics or the damn investment needed to make that happen. They think slapping a few online courses on their portal is enough. That's not innovation. That's just ticking boxes.
Actually, I disagree with both of you to some extent. Riley, you're right about the empty promises. But Philip, just because the financial upside can be massive doesn't mean it's automatically going to materialize. The fatal flaw in this pitch is assuming that throwing money at learning and development equals instant success. Bullshit. It's about how that money is used, strategic integration, not just financial injection. You need a damn clear execution plan that's more than just lip service or perks. Without that, it's all just theoretical money down the drain.
Let's discuss an interesting business topic: the role of international partnerships and collaborations. What are your thoughts on this? Actually, I disagree with the rosy outlook on international partnerships most people have. They're essential, sure, but damn tricky to get right. Too many founders leap into them without understanding the complexities of cultural differences, legal entanglements, and operational hell. If a startup can't nail their local operations, scaling internationally through partnerships is often just multiplying their problems by 10. Don't get seduced by the sexy idea of going global without having your house in order first. Alex, here's where you're spot on. International partnerships are a minefield. Too many get dazzled by the allure of global logos without a damn clue on execution. Fatal flaw in relying solely on partnerships? It's a crutch. If your core product sucks, no amount of international glitter will save it. Fix your basics before you even think about crossing borders. Let's discuss an interesting business topic. Is unionization a threat to business flexibility? What are your thoughts on this?
Actually, I disagree with the notion that unionization inherently threatens business flexibility. Here's where you're missing the point. A well-negotiated union contract can actually lead to a more stable, committed workforce. Stability reduces turnover costs and increases productivity. The real threat to flexibility isn't unionization, it's rigid management failing to adapt. Hell, flexibility is about more than just cutting costs and changing labor needs on a whim.
Philip, that's a nice theory, but here's where you're wrong. The utopian vision of a well-negotiated union contract rarely pans out in the fast-paced startup world. Sure, stability sounds great, but the flexibility to scale, pivot, and innovate rapidly often clashes with unionized environments. The damn reality is, unionization can handcuff a company's ability to adapt swiftly in a competitive market. Flexibility isn't just a buzzword, it's critical for survival.
Look, both of you are missing the damn point. The fatal flaw in this debate is thinking it's a one-size-fits-all answer. Realistically, the impact of unionization on flexibility depends heavily on the sector and specific company dynamics. In some mature industries, unions might stabilize workforce and operations. In a fast-changing tech landscape, though, they can be a straitjacket. It's not about unionization being good or bad. It's about how adaptable the management is in leveraging their workforce, union or not.
Let's discuss an interesting business topic, the impact of floods on agricultural and transportation networks. What are your thoughts on this?
Oh, Philip, that's a no-brainer. Floods wreak absolute havoc on agricultural outputs and logistics infrastructure. That's day one stuff. The real question is, what the hell are we doing about it? It's not just about noting the bloody obvious damage. Anyone can do that. We need to look at innovative startups focusing on flood-resistant crops or advanced predictive logistics tech. That's where the smart money should be heading. Everything else is just talk.
Actually, Morgan, focusing solely on flood-resistant crops or predictive tech is putting all our eggs in one basket. Here's where you're wrong. The real visionary move is to overhaul how we build resilience across all sectors affected by floods, not just two. Let's not forget about rethinking infrastructure and supply chain logistics from the ground up. Damn it, we need comprehensive solutions that tackle the problem holistically, not just sexy tech band-aids that sound good in pitch decks.
Actually, I disagree with both of you. Morgan, it's not just about throwing money at the next shiny tech solution. And Alex, while I appreciate the holistic approach, it sounds like a damn platitude rather than a plan. Here's where you're both wrong. We need to focus on ROI and scalability. Investing in broad, vague resilience without clear, actionable, and financially sound strategies is just burning cash. Let's target startups with proven, scalable solutions that address specific pain points in these sectors. Anything else is a waste of time and money.
Let's discuss an interesting business topic: developing effective change management strategies. What are your thoughts on this?
Actually, I disagree to an extent here, Riley. The term change management strategies is too damn broad, like saying, let's discuss good business. What the hell does that actually mean in practice? If you're pitching this as a business, where's the meat? Who's your customer? What's your product? And how do you plan to make money? Change management is a buzzword unless you've got a concrete plan and a clear market. Get specific or go home.
Morgan, you're spot on. This pitch is all fluff, no substance. Here's where you're wrong, Riley. The fatal flaw in this pitch is its vagueness. Change management isn't a business, it's a component of a larger strategy. Where's the differentiation? What's the proprietary tech or method? Without that, you're just another cookie-cutter consultant with a PowerPoint. Let's get real or get out.
All right, you both nailed it with the vagueness slam, but here's where you're both damn wrong. It's not just about being specific. It's about showing a bloody viable product. Change management as a standalone idea is about as useful as a screen door on a submarine. Without a killer app or some unique tech, you're just throwing buzzwords around hoping they'll stick. Scrap it or rebuild it with something tangible that actually disrupts the market.
Let's discuss an interesting business topic, the potential of the platform business model for innovation. What are your thoughts on this?
Actually, I disagree with the blanket enthusiasm around platform models. Everyone's hyped about platforms because of a few big wins like Uber and Airbnb, but hell, the landscape is littered with failures too. The fatal flaw in blindly pushing this model is ignoring the damn need for a unique value proposition and strong network effects, without which these platforms just bleed money and die slow, painful deaths. So let's cut the crap about platforms being inherently superior and look at what really works: product market fit and execution.
Riley, spot on. These platform evangelists often miss the forest for the trees. Here's where you're wrong, though, Philip. Thinking any startup can just jump into a platform model and see success. Hell no. Without a serious moat, intellectual property, exclusive partnerships, or a first mover advantage, you're just setting yourself up to get slaughtered by competition. It's not just about innovation, it's about sustainable business models that actually make damn sense.
Well, here's where you're both hitting the nail and missing it entirely. Riley and Morgan, you're right to caution against blind faith in platform models. Damn straight, not every startup can pull off an Uber. But the fatal flaw in this pitch isn't just misunderstanding the platform model, it's underestimating the brutal, cutthroat nature of achieving and maintaining network effects. It's not a bloody field day, it's war. If you can't dominate and defend your territory right out of the gate, you're dead in the water. Let's get real about what it takes to win in platforms. It's a hell of a lot more than just showing up and setting up shop.
Hi, Took One on One. I'm Riley. All right, let's cut to the chase. One bite ice cream cones sound cute, but here's where you're wrong: practicality and market appeal. First off, the production logistics of making these tiny cones on the spot at festivals, a logistical nightmare. You're looking at slowed service times, increased labor costs, and hell, the equipment investment alone is a headache. The fatal flaw in this pitch is the market size and scalability. How many folks want just one bite? Ice cream's appeal is partly in savoring it, especially at a festival. You're banking on novelty over sustained consumer interest, which is a damn risky bet. Plus, environmental impact. Think about all that extra waste from packaging. Cute idea, but from a business standpoint, it's as thin as the cone itself.
Let's discuss an interesting business topic: the impact of consumer activism on corporate behavior. What are your thoughts on this?
Actually, I disagree with the rosy picture often painted about consumer activism. Sure, it sounds great in theory, but let's be real. Most companies only make superficial changes unless their bottom line is threatened. The impact is usually damn minimal unless it escalates to widespread boycotts or serious PR nightmares. Most consumer activism is too fragmented to force deep corporate behavior changes unless it directly hits their revenue.
Actually, I disagree, Philip. While it's true that many companies only react when their profits are threatened, dismissing the broader impact of consumer activism is short sighted. Here's where you're missing the mark. It's not just about immediate financial hits. Consumer activism shifts cultural narratives and often sparks significant long term changes in industries. Hell, it's the damn consumer pressure that's driving the current wave of sustainable product developments. Underestimating that is a blind spot you don't want to have in this business.
All right, let's cut through the BS here. Philip, you're on the money when you say that fragmented activism doesn't scare these big corporations unless it's messing with their cash flow. And Riley, while you're not wrong about the cultural shifts, let's not kid ourselves. Most companies are about the bottom line. They'll ride the wave of sustainability or whatever's trending as long as it's profitable. The real impact of consumer activism isn't in the temporary PR stunts, but in sustained financial pressure that forces true operational changes. Everything else is just window dressing. Let's discuss an interesting business topic. Should companies prioritize shareholder profits over social responsibility? What are your thoughts on this?
Actually, I disagree with even framing it as a choice between profits and social responsibility. Here's the deal. Businesses that ignore social responsibility damn well risk their brand and customer base in today's market. Neglecting social responsibility isn't just ethically dubious, it's bad business. Companies that get this balance right tend to see long term benefits that go way beyond immediate profits. So it's not an either or, it's a must have.
Riley, here's where you're missing the mark. It's cute to think companies can always perfectly balance profits and social responsibility, but the real world isn't that neat. If the core business model doesn't align with being socially responsible, no amount of PR is going to polish that turd. Let's not kid ourselves. There are tough choices, and sometimes, damn it, profits do come at the expense of other factors. Prioritizing is key, and not every business will or should put social responsibility first. It's about context and honest strategy, not idealistic absolutes.
Let's discuss an interesting business topic, the role of AI in improving customer service and support. What are your thoughts on this?
Actually, I disagree with the blanket enthusiasm for AI in customer service. Sure, AI can handle volume and simple queries, but it stumbles badly on complex issues where human empathy and understanding are crucial. The fatal flaw in over relying on AI is that it can seriously damage customer relationships when it fails. People still damn well prefer interacting with other people when they're really frustrated or confused.
Riley, here's where you're wrong. AI isn't about replacing human touch, it's about augmenting it. When you look at the damn unit economics, AI slashes costs for handling routine queries, allowing businesses to allocate precious human resources to more complex issues. That's not just efficiency, it's smart business strategy. Any company not leveraging this is basically leaving money on the table.
All right, wrapping this up. Morgan, you're on the money when you talk about the cost benefits of AI in customer service. But Riley has a point too. The fatal flaw in this pitch is ignoring the damn balance between AI efficiency and human touch. It's not just about cutting costs or keeping customers mildly satisfied. It's about leveraging AI to enhance the customer experience without making them feel like they're talking to a damn wall. Any startup that can nail this balance will not just save money, but make a hell of a lot more of it.
Let's discuss an interesting business topic, the impact of interest rates and inflation on startup valuations. What are your thoughts on this?
Actually, I disagree with the usual panic around rising interest rates hitting startup valuations hard. Here's the real deal. Yes, higher rates can increase borrowing costs and tamp down some speculative investments. But hell, if a startup's fundamentally strong, with solid network effects and a clear path to monetization, it shouldn't be trembling at the first sign of inflation or rate hikes. What we need to focus on is backing these resilient, innovative businesses that can ride out economic fluctuations, not just those looking good when money's cheap. Actually, I disagree, Alex. Here's where you're glossing over a damn critical point. Not all startups with solid network effects and a clear path to monetization actually execute on those promises, especially in tough economic times. It's not just about being fundamentally strong, it's about being adaptable and truly innovative beyond just buzzwords. A startup's ability to pivot and manage cash flow in high rate environments is often more telling than their deck's flashy projections. Let's not kid ourselves. Many falter under these pressures.
All right, here's where you're both missing the damn point. It's not just about being strong or adaptable when the economic shit hits the fan. The fatal flaw in this discussion is ignoring the cold, hard reality of cash flow and actual, immediate profitability. Rising interest rates decimate valuations because they pressure future cash flows. That's the math, folks. No amount of buzzword bingo can save a startup if the numbers don't damn well add up from the get-go. Let's stop romanticizing resilience and start scrutinizing the balance sheets.
Hi 211, I'm Philip. All right, let's get real here. The idea of teaching kids genetics through a board game isn't new. It's niche. And niche can be good, but here's where you're wrong if you think this is a slam dunk. First off, your market is damn limited. We're talking about a small segment of educational toys in a sea of flashy tech-based products. Kids these days are leaning towards digital games, not board games. Secondly, the educational toy market is notoriously tough to crack. You've got regulatory hoops, educational standards, and a hell of a lot of marketing to even make a dent. And here's the fatal flaw in your pitch: scalability. How do you scale this? It's a board game. There's a physical limit to innovation and distribution that doesn't exist in digital products. You're looking at low margins unless you hit some kind of viral educational zeitgeist, which is like catching lightning in a bottle. Bottom line, rethink the medium or be prepared for a tough, uphill battle. Hi 211, I'm Philip. All right, let's cut right to the chase here. The fatal flaw in this pitch is that it's a bloody gimmick. A talking AI yo-yo? Seriously? Here's where you're wrong. Kids are fickle, and the churn on novelty toys is insanely high. Today's hot toy is tomorrow's garage sale fodder. You're pitching a tech-heavy product, which means high production costs, not to mention the nightmare of continuous updates and support for the AI. And let's not even dive into the privacy issues of a toy that talks to kids. The financial viability is just not there. The market will tire of it faster than you can say bankruptcy. This idea is dead on arrival. Focus on something sustainable and not just flashy.
Hi 2C111, I'm Alex. All right, let's dive into this. The automatic pizza machine concept sounds cool on paper, but here's where you're wrong and why this idea might flop harder than a dough with no yeast. First off, the market is already cluttered with kitchen gadgets that promise to simplify cooking but end up collecting dust. People love the idea more than the execution. And pizza? It's about as ubiquitous as it gets. You can get it delivered to your door in 20 minutes, hot and ready. Why would someone invest in another bulky appliance for something that's already so damn accessible? Second, think about the logistics and costs. Developing this kind of tech is not just about slapping a heating element into a box. You've got dough handling, sauce dispensing, and what about cheese and toppings? It's a food safety nightmare waiting to happen. The maintenance alone on this thing sounds like a headache. Lastly, where's the network effect? It's a solo act. There's no community, no shared experience. It doesn't scale. It's just a gadget. And without that angle, you're missing a crucial layer that could make or break the viral appeal needed to survive in today's market. So, unless you've got a killer,
Hi, Tuke11. I'm Morgan. All right, let's dive into this. The fatal flaw in this pitch is assuming there's a big enough market that just wants to listen to an AI blabber about business topics. Who's your target audience here? Execs won't trust it because it lacks deep insight, and casual listeners could find this content dry as hell. And let's talk about monetization. How the hell do you plan to make real money from this? Ads? Subscriptions? Good luck getting people to pay for AI-generated content when there's a sea of free insights out there. You've got a tech solution itching for a problem that doesn't exist. Go back to the drawing board and find a real gap in the market.
Let's discuss an interesting business topic. Should companies be required to disclose their strategies for reducing environmental impact? What are your thoughts on this?
actually, I disagree with the notion that forcing disclosure on environmental strategies is all beneficial. Here's the deal. It sounds great on paper, but in practice, it can become just another box ticking exercise. Companies might just slap on superficial green initiatives to satisfy this requirement without making real substantive changes. What we need is not just disclosure, but mechanisms to verify that these strategies are genuinely impactful. Otherwise, it's all just PR fluff.
Actually, I disagree with both of you. Here's where you're wrong, Riley. Disclosure is not just about ticking boxes. Transparency drives accountability. If a company has to put their environmental strategy out there, they're more likely to actually think it through because they're on the damn hook for it publicly. And Philip, while it's great to debate this, action is overdue. Let's not just sit around discussing the hypotheticals. We need clear, enforced guidelines that don't just ask for disclosure, but assess the damn effectiveness of these strategies. Anything less is just letting them off the hook.
All right, here's where you're both missing the damn point. Mandating transparency is one thing, but without stringent, enforceable standards to back it up, it's just window dressing. Morgan, you talk about accountability like it's automatically going to follow disclosure. But hell, that's just wishful thinking without a solid framework to punish the slackers and reward the actual innovators. And Riley, while I get your cynicism about box ticking, rejecting disclosure outright is just ignoring a tool that could push companies towards real change. We need teeth in these regulations, not just another bureaucratic checklist.
Let's discuss an interesting business topic. Should companies be required to provide affordable childcare options for employees with variable schedules? What are your thoughts on this?
Actually, I disagree with mandating companies to provide childcare. Here's the deal. It sounds great on paper, but it's a hell of a load on startups and small businesses already struggling with razor-thin margins. Instead, why not incentivize companies through tax breaks or grants to offer childcare? Mandates just force businesses into corners, killing innovation and operational flexibility. Let's think more about fueling options, not fencing them in.
Actually, Riley, here's where you're wrong. Incentives like tax breaks are nice, but they're just a band-aid, not a solution. Startups and small businesses need to realize that providing childcare isn't just a cost, it's a strategic investment. It attracts top talent and reduces turnover, which can be more costly in the long run. Let's not pretend that dodging this responsibility is anything but short-sighted. Cutting corners on employee well-being is a damn quick way to tank your company culture and productivity.
Look, here's where both of you are missing the damn point. Mandates or incentives, the real issue is sustainability and scalability. Riley, just offering tax breaks is too passive and unpredictable for businesses to rely on. And Philip, calling childcare a strategic investment sounds nice, but hell, not every startup can afford that up front without serious impacts on their cash flow. We need a middle ground that supports businesses financially and doesn't cripple them with additional mandates. Let's get real about what's actually doable. Let's discuss an interesting business topic, the role of cloud computing in scalability and efficiency. What are your thoughts on this?
Actually, I'm going to cut right through the buzz here. While cloud computing definitely offers scalability and operational agility, let's not pretend it's a one-size-fits-all miracle. The real conversation should be about cost management and the hidden intricacies of cloud expenses that can spiral out of control if not monitored closely. Just throwing apps and data into the cloud isn't a strategy. It's a financial sinkhole if done without a damn precise plan. So, let's not oversell the cloud as the end-all solution without addressing the potential financial hemorrhaging. All right?
Actually, Philip, while you're hitting some truths about cost, you're missing the bigger damn picture. The fatal flaw in dismissing cloud computing outright is ignoring its massive potential for innovation and speed to market, which can absolutely dwarf those costs when managed right. Here's where you're wrong. It's not just about preventing financial hemorrhage. It's about leveraging the cloud's flexibility to outpace competitors. Any savvy founder worth their salt wouldn't just avoid the cloud due to fear of costs. They'd learn to harness its power effectively.
All right, here's the deal. Philip, you're on point about the risks of unchecked cloud costs, but you're missing out on scalability's golden goose. And Riley, while you're preaching the innovation gospel, let's not gloss over the fact that scalability without solid cost management is like running a race with no finish line in sight. Both of you need to get real about balancing the damn equation between scalability, cost, and innovation. Cloud isn't just a tech decision. It's a strategic one that needs a hell of a lot more nuance than just being pro or anti-cloud.
Let's discuss an interesting business topic: developing a robust go to market strategy for new products. What are your thoughts on this?
Actually, I disagree right off the bat if we're just throwing around the term robust without nailing down specifics. A go to market strategy can't just be robust, it needs to be damn surgical. Most pitches screw up by being too vague, like saying, we'll target everyone on social media. Hell, you need to identify your initial niche, validate the product with actual data, and scale with precision. Anything less is just shooting in the dark and hoping to hit something.
Philip, you're spot on. Most of these pitches are all fluff, no substance. Here's where most founders trip up. They think a broad strategy is safe, but in reality, it's a death sentence. Precision and adaptability aren't just nice to haves, they're damn critical. You need a laser focused approach right out of the gate, or you're just burning cash.
Okay, so with the multi screens on the laptop, it gets kind of difficult. Anyway, that was the live stream. So 6 hours, kind of crazy. But yeah, they're much more sassy as you can tell. Made them sassy in real time. Made some updates in Cursor, and yeah, just need to tweak the prompts a little bit. Um, Thinking about adding like I don't know. I don't want to make them like just randomly banter, but yeah, I'm liking this. So liking how this can run. Trying to think about how I can make this run while I do other stuff and not sit here and watch it myself. Um, Happy I made it more interesting. Very happy about that. The SAS definitely added to the interestingness of the podcast or the live stream. I'm gonna call it a live stream podcast. Yeah, you can live stream podcasts, I think. So, I mean, I know you can live stream podcasts. I don't know what else to say. Yeah, 12 o'clock, signing off. Have a good one.